everyone. It's time to kick off our conference. So, buenos dias a todos. It's an honor to be here to welcome you to this inaugural edition, I should say, of our Chapultepec conference. We hope this to be the first of many. This is a special gathering of very high-level policymakers in the Americas and elsewhere. I see many friends, many governors from all countries in our continent, but also from Europe. I see high-level academic participants, private sector, especially here from our host country, Mexico. So it's a great honor for me to be here in this position, starting this conference, which we think that is going to be very important for our central banking and financial community in the Americas. We have a very wide range agenda for today. I'm sure we will have a very productive journey here. We start in the morning with the macro-financial developments in this rapid pace of technological change. We have discussions on both the financial stability domain, but also on the innovation side. During our lunch session, we will have the privilege to hear from our general manager of the BIS, well known of all of us, Agustin Carsten, which will share his wisdom not only as the general manager of the BIS today, but also in his long and very successful career in central banking and finance. In the afternoon, we will discuss challenges for central banks, again in the digital era, especially regarding these sort of advancements in general artificial intelligence and how do central banks position themselves in this new era. We then will reflect on the crucial lessons learned on how central banks have navigated this very important and I should say extreme economic shock, which was the COVID-19 crisis. And our final session will look ahead, examining the main challenges the central banks in the Americas and elsewhere should be facing in the years to come. So I'm sure that this conference will be very productive. We have an inspiring agenda. We have very high caliber speakers and panelists. So I'm looking forward to the discussions today. So to begin our work, I will give the floor to Ana Aguilar, which is our host, regional advisor to the BIS Americas office, which will be she will be the master of ceremony of today's work. Thank you very much, and let's have a great conference today.
So, good morning, everyone. We are pretty pleased to have you here in the first edition of the Chapultepec conference in Mexico City. My name is Ana Aguilar, and I'm honored to be your host in this first edition of the conference. I have a few housekeeping notes. To keep the time, we will ask speakers and panelists to please stand by the stage before your session begins. Our team from the BIS is ready, of course, to help you with any question regarding logistics that you may have. And please be advised that photograph will be taken in the conference for internal and external communication purposes. So please smile. And finally, our conference is being live streamed. So thank you for being here, and we look forward for exciting discussion at this Chapultepec conference. And by the end of the day, we hope that we all can spell correctly Chapultepec. So let's start with our first session. Uncertainty will almost certainly be in the top of the minds of policymakers in the Americas during 2025, and I will say in the world. And this is our first topic for today, evolving global financial conditions under heightened uncertainty. Of course, uncertainty around trade policies, geopolitical tensions, and fiscal issues across a number of economies have the potential of increased volatility in long-term rates, capital flows, and macroeconomic outcomes. Hence, financial conditions in Latin America for sure are going to be influenced by global trends. I am very pleased to introduce our moderator for this first session, Gaston Gelos, who is Deputy Head of the Monetary and Economic Department and Head of Financial Stability Policy in the BIS. Gaston was also formerly at the IMF, so he knows our presenter, Tobias Adrian, very well, who is eminently qualified to speak in our first topic of today. Please join me in welcoming Gaston Gelos and our presenter, Tobias Adrian, to the stage. Gaston, the floor is yours.
Thank you. Thank you. Well, it's my pleasure to moderate this session and in front of this very distinguished audience. We have clearly entered we have been entering for a while already a period of high economic and policy uncertainty, partly driven by unknowns regarding trade policy, but not only. There are uncertainties that are also very important for the region, such as migration policies. This uncertainty comes against the backdrop of fiscal and debt trajectories that are very concerning in many economies. It comes also against the background of economic divergence between the US and the rest of the world. And this divergence has also been manifesting itself in longer-term yields and strengthening of the US dollar. Now, this strengthening of the US dollar in turn is likely to contribute to a tightening of financial conditions, as Anna was already alluding to, which may pose challenges to many economies in the Americas. So, in this uncertain environment with many challenges, it is particularly important to try to understand where the vulnerabilities lie. And here there is an eminently qualified speaker to talk about this. He will talk about evolving global financial conditions under heightened uncertainty. Tobias is, of course, very well known. He is the financial counselor and director of the Monetary and Capital Markets Department at the IMF. I had the pleasure of having him as a boss for a few years. And there he oversees a wide-ranging portfolio of activities. Prior to joining the IMF, he was a senior vice president at the Federal Reserve Bank of New York and associate director of the Research and Statistics Group. He has a very distinguished research record spanning macrofinance, monetary policy, financial stability, and climate finance, with a focus on aggregate consequences of capital market developments. He holds a PhD from MIT and an MSc in econometrics and mathematical economics from the LSE. Tobias, thank you for being here. The floor is yours.
Yeah, thanks so much, Gaston. And we do miss you at the fund, but the BIS is a great place. There are so many former colleagues and friends at the BIS, and also in the audience. So let me go a little bit quickly through the slides so that hopefully we have time for discussions as well. And if there's anything unclear, please do interrupt me at any point in time. Here, the high level global financial stability pitch that we are seeing at the moment. So first of all, of course, the global policy environment is shifting. Monetary policies are starting to diverge. There was a humongous amount of convergence during the pandemic and the post-pandemic inflation, and there's more and more divergence. I will go into that. Fiscal and inflation concerns are putting pressures on longer-term rates, so there's a huge focus on longer-term yields. I'm going to go into that. The dollar has strengthened tremendously. This is, of course, reflecting the strong performance of the US, but it is challenging for emerging markets because, in general, dollar strength is causing financial condition tightening in emerging markets. And of course, US equity markets have strongly outperformed peers around the world. I will also go into that. Now, in terms of risks going forward, I think one risk that we're hearing quite a bit from market participants is all like, the view that US equities may be priced to perfection. So some are expressing a view that there could be a downside. Though, for the moment, certainly financial conditions globally are very accommodative. And again, I will go further into that. Secondly, we have a number of countries, in particular emerging markets and developing economies, with limits in terms of policy space. The global environment could put further pressures here. From the corporate sector, there are refinancings coming, even though yields have come down, spreads have come down, many corporates have to refinance at higher rates. So let me first talk about the heightened uncertainty, which was one of the topics for the panel, and then secondly about some punchlines for financial stability. So our growth outlook, so this is really from the WIO update in January, we see that for 25 we've upgraded the US quite notably, and China was also upgraded somewhat, while other emerging markets and other advanced economies were downgraded. In terms of the longer term trend, basically, the US is basically back to trend growth, the post World War II trend growth. In that sense, when you look at the US yields and, in many ways that is sort of like reflecting going back to like pre-GFC, right? We are at 4.5% in the US, which is back to pre-GFC, and so like trend growth is back at those levels. So, the rest of the world, though, has seen the deterioration of growth, right? And you can see that in the middle chart. So this is really something that has been going on over 20 or 30 years, that medium-term growth outlooks globally have been coming down. Now, inflation is really a very positive story. There was this huge inflation surge. Inflation is coming down. Of course, price levels have not, right? So inflation is down, but price levels have not. But in terms of the way in which we think of monetary policy, there's really a big achievement. Now, financial conditions remain very accommodative. So the right chart gives you our financial conditions index. So this is really our view of the price of risk across different asset classes. And you can see there's a very slight tightening in the last quarter, but broadly it's very accommodative around the world. Despite the fact that geopolitical risks are somewhat elevated, though they haven't risen dramatically, they of course spiked when Russia invaded Ukraine, but more recently they haven't moved very much. Of course, trade uncertainty has increased, but really that has not panned out in terms of adverse moves on global financial conditions. Now, monetary policy is diverging, and that really reflects this differential performance across countries. So here I'm zooming in on four major monetary areas: the US, Japan, Euro area, and China. And basically, the N25 rate expectations have been massively upgraded in the US, but also in Japan, while they've been downgraded, meaningfully in the euro area and to some extent in China. And so this differential performance really reflects differential performance in terms of inflation and output. Inflation is coming down in the US, but it is still a little bit above target. So here we're showing you break-evens. They've come up a little bit. This is very, very much within historical ranges, so I wouldn't say there are any issues here. And Japan, of course, is still sort of like moving the underlying inflation to target, while, say, in Germany, inflation continues to drift down to some extent. I don't have break-evens for China, but of course in China also inflation has been drifting down. The CPI print, the most recently, continued to drift down. And then that in turn is reflecting growth performances to a large extent, with the US surprising to the upside, euro area to the downside, and Japan and China somewhere in the middle. So this is the divergence. Now, there's also a sort of longer-term divergence, and here I'm plotting 10-year yields for 4 countries, US and Germany on the left, and then China and Japan on the right. And so, the way I look at that is that, German and US 10-year yields were very highly correlated pre-GFC. And then with the European sovereign crisis, they started to diverge. And if anything, this divergence is becoming more pronounced. So basically, German yields are, meaningfully lower than US yields. That is, to some extent, reflective of this difference in the growth outlook. China and Japan also has an interesting development in terms of 10-year yields, and that's the opposite. They're actually converging, where Chinese 10-year yields are coming down and Japanese 10-year yields are coming up. And actually the 30-year yields have already crossed, right? I don't want to go too much into this here at this point, but of course that is reflecting, term premium to some extent, but to a large extent, so like the expected future policy path, which in turn has to do with growth expectations. Now, zooming a little bit more into the US, of course, US policy really matters for all emerging markets, including Latin American emerging markets. And the very, very unusual fact here, which is very different from normal monetary policy tightening easing cycles, is that even though, of course, the policy rate has dropped since September by 100 basis points in the US, right? The long-term yield has actually increased by about 100 basis points, right? So basically the curve has steepened by 200 basis points, right? And that is quite unusual. And what I'm showing here on the left is sort of like a comparison to previous monetary policy easing cycles. And normally, when the Fed is easing, longer-term yields also go down. And that has not been the case this time, and I think it's important to consider this. Now, when we look at what is driving that increase in the 10-year, it's largely real term premium, right? By over 100 basis points, these real term premium have come up, again, so the 10-year yield, in some sense, is back to where it was in 2005. So the real risk premium has come up, but really it's back to 2005. It's really reflective of the fact that we are beyond the zero lower bound, secular stagnation kind of environment. At the moment, we're in an environment where growth is high, inflation is slightly above target, but it's quite different from the post-GFC era. I think it's a very important backdrop for every country to really understand this dynamic. Now, when we look at the term premia, they really have gone up around the world. So here's a sample of advanced and emerging markets in the left chart, and you can see that term premia have gone up in the US, but also in most countries elsewhere, with China being an exception where term premia have come down. which we think is reflecting a reallocation of risk from risky assets into safer assets, both housing and equities to some extent into bonds, with some reversal in recent months. Now, the right chart shows you a more regression-based approach where we ask, what is the average impact under two scenarios? So how do term premia for countries evolve, either when domestically in each country the deficit deteriorates by 1%, okay, or the spillover of US term premia to those countries increases by 10 percentage points. So that is the magnitude of increase in the spillover coefficient that we have observed over the past 2 years or so. So basically, in a causal way, so using identification, term premia are spilling over more into other economies by roughly 10%. And imagine that continued going forward. And so what we're finding is that this term premium spillover is of 10% more spillover is quantitatively similar to an increase in the deficit domestically in all countries by about 1%. And when you look across the countries, the punchline for LATAM is much worse than for other countries, okay? So that really reinforces the importance of fiscal prudence across countries. And the backdrop, of course, is one where debt to GDP has gone up everywhere, and that impacts pricing of duration everywhere. And of course, quantitative central bank policies are being unwound, so the net supply is changing, and that has an impact on pricing. So I think it's something that will remain a first-order theme going forward. Now let me talk a little bit about risks to financial stability. I'm sure you're all playing chess with your cat over the weekend. So one thing, this slide has given me a lot of pause for thought or sleepless nights. So what I'm showing you, is very simple. The left chart are cumulative equity returns for the S&P 500 in green. That's basically 140% cumulative return. Japan, which is about 100% return. Europe is about half of that. And then emerging markets, and here we're breaking out total emerging markets, MSCI, versus China. And basically, MSCI, total emerging markets, cumulative returns are basically flat since 2019, right? So, that is quite dramatic, right? Now, that really is extending a longer-term trend. So the middle chart goes back to 2010, where we just show the share of world equity market capitalization. And so the US market cap has gone from 30% in 2010 to 50% in, as of now, right? And so the reasons are outperformance, which is very closely tied to the Magnificent Seven and technology, is not that unusual in the longer term, right? So I think this is quite important, and you can see that the share of some other countries have been coming down. Now, when you look at LATAM, which is pointed out there, the share has also come down quite meaningfully, right? So I think it's something that really is important to reflect on. And so the right chart is thinking about valuations in equity markets. And so there are many different ways to think about valuation. So what we're doing here is to ask about what is the growth forecast from analysts. That's the green bar. So basically, US earnings growth has continued to be, very, very strong. Emerging market earning growth is actually pretty strong. And other advanced economies, is also strong, though not quite as strong as the emerging markets or the US. But basically, when you then ask in terms of valuation, so price-earnings ratios, what would it take to come back to historical levels of price-earnings ratios? Basically, EMs don't need any earnings growth, so they are already at the historical average. Advanced economies are basically, going to be there, whereas the US, has somewhat stretched valuations. And so this is where, when we talk to market participants, there's some divergence of views as to, how much risk that represents. Dollar strength is tightening financial conditions. We have seen since last September, since the Fed started to ease, we have seen the dollar rally. Of course, long-term yields have come up, and equity markets have rallied very strongly in the US relative to the rest of the world. So both yields going up and markets rallying has contributed to dollar strength. And of course, that does mean financial conditions are tighter, and that is more so in EMs, that's the right chart, than for the rest of the world. So emerging market monetary policy, is somewhat constrained by that, right? So basically, inflation on average is sort of like back to target. Again, there's heterogeneity, but when you look at LATAM, Central Europe, Eastern Europe, Asia, advanced economies, you're basically back to target. So the inflation episode is behind us. Of course, the price levels have not converged back. But you can see that the EM policy rates are at quite higher levels, right? And part of that is reflective of differentials. So the differentials are higher. And part of it is these higher term premia, as we have seen earlier, right? And so, how do you think about, R star plus the term premium? I don't know that R star has come up, though that's debatable, but term premium have come up for sure. So that's problematic. Now, here's the other chart that sort of like keeps me awake somewhat at night. Here we are looking at cumulative equity returns on the left chart again. This is just zooming into Latin America. And you can see that there's a divergence across Latin American countries. But again, the US is sort of like, strongly outperforming all of these major LATAM EMs. But then when you look at the sovereign bond returns, and here you can look at either local returns or dollar returns, it's quite similar. Basically, this is just pulling the Bloomberg, cumulative ex-post bond return from indices. You can see that for LATAM, basically, those returns have been flat, and both US high yield and private credit have strongly outperformed, right? And so here again, I think it gives me quite a bit of pause for thought in terms of, the cost of capital going forward. Now, associated with that observation really is the fact that local currency bond markets, right, they've seen inflows, but the inflows have not kept up with the issuance of local debt markets. And developing local debt markets is a huge priority for every country, and we are working with many countries to develop local debt markets. But basically what we have seen, and that's shown in the right chart across the range of emerging markets, basically the share of foreign investors in those local debt markets is actually coming down quite dramatically, right? And that, again, is giving me quite a bit of pause for thought in terms of how to think about sort of like capital flows, investments going forward. Now, this is the final slide, 13, on corporates. Basically, corporate spreads are historically tight. And sovereign spreads are also quite tight, right? So in that sense, financial conditions are very favorable. But of course, the base level of rates is higher. And so, corporates globally have to refinance, and they had locked in those low rates, and they are expected to have to refinance at higher rates. So that will put some pressure on the corporates. Now, of course, growth remains strong. But monitoring sort of like corporate performance is key. In private credit markets, we see that payment in kind, so this is all like reprofiling of debt, the share of payment in kind is going up. This is looking at the US, private credit universe. And so we are monitoring like the credit quality very closely. Of course, in private credit, we have seen this extraordinary performance. So now there's a lot of capital allocated flowing in, and so making sure to understand what is happening to underwriting standards as there's more capital allocated to the space is very first order. So let me stop here.
Thank you very much, Tobias, for this tour de force. We have a few minutes for questions. Agustin, please.
I can hear you.
Thank you, thank you. Well, thank you, Tobias, for this great. This is on. Do you hear me? Yeah, for this great presentation. I have two questions. One very pointed one, quick answer. The impact on the risk premium of fiscal deficit on Latin America is quite large, and I certainly would sympathize with that. How much is that affected by a few countries? I mean, Argentina, probably Brazil. So just, I mean, that just sort of reinforces the message, but I just was curious. And the second, I think a little bit more broader. I mean, I fully agree with all the warnings you are issuing here, you're pointing out, they're very good. Now, also what we have seen during the last 2 or 3 years are bouts of extreme global volatility in markets, like situations where sort of markets break down. Some, obviously many of them associated with probably the trend towards increasing interest rates, and so on and so forth. But then, you know, I have the sense that there is something there that we might not be fully seeing. For example, when the carry trades break down and the amount of volatility that spurs, and certainly that has an important impact on Latin America. So what are your thoughts on or how do you conceptualize, is this going to increase in the future where we will have more bouts of extreme volatility, or is something that was concentrated in the recent past because many central banks adjusting their monetary policy stance? So those are my questions. Thank you.
Do you want me? Okay. Excellent questions, of course, Agustin. So let me start with the first question on the term premia in Latin America. And you're right to point out that there's, of course, quite a bit of country heterogeneity, and I showed you some of that. So you asked specifically about Argentina and Brazil. Of course, Argentina has seen a tremendous fiscal adjustment, and you know, you can see the benefits of that fiscal adjustment in the pricing of debt. You know, in Brazil, when we look at our yield curve decomposition, we actually do see term premia coming down in Brazil, unlike the other Latin American countries. So we think that you know, yields going up is a little bit more related to monetary policy expectations there, according to our decompositions. But of course, I would be, you know, very curious to hear from the Brazilian governor as well on this issue. You know, in the other countries, we do see this broad rise in term premia alongside advanced economies, as I showed you. And that is really reflective of the fact that, you know, globally, you know, a sovereign debt supply has been increasing. You know, central banks have been ratcheting back their balance sheets, so the net supply in private hands has been coming up. So you know, it's more like a normalization since the pre-GFC, but it is certainly something we watch very closely. Secondly, in terms of bouts of volatility, so markets are adjusting to news. So there is a sort of like natural base level of volatility. When we look at equity market volatility or interest rate volatility, rate volatility was somewhat elevated. It's coming down to some degree. And equity market volatility is around historical averages. But of course, there are these bouts of volatility. And the question is, are there sort of like nonlinear amplification mechanisms? Are there some sort of like, hard to detect derivatives positions, for example? You mentioned the carry trade. I think the unwind on August 5th last year is very fresh in our minds, and that had spillovers to emerging markets, for example, in Latin America. So I would say three things here. So number one, we did see in August very quickly market players with longer-term investment horizons coming in very quickly. For example, in Japan, the insurance funds and pension funds, came in a stabilizing fashion. Sovereign wealth funds often come in as well in a stabilizing fashion. So, while they might be unwind of levered trades sometimes, you do have these longer-term investors as well. And that is one stabilizer. I think the second stabilizer are the central banks. So, clearly when financial conditions tighten in a manner that has macro implications in terms of macro downside risk or the macro baseline, then of course the central banks are going to adjust in terms of injecting liquidity. And again, when you think about the August 5th episode, certain central banks, quickly came in with statements. There was no policy change, but there was certainly an adjustment in communication. And I think central banks are very attuned to the fact that financial conditions play a major role in terms of monetary policy transmission. Many central bank governors acknowledge that. In the academic literature, this is sometimes referred to as financial conditions targeting. And then finally, I would really underline the importance of financial regulation. We are in a world where banks have more capital and more liquidity. I think we have done also a lot of advances over the past 15 years in terms of having a well regulated non-bank financial sector. So I do think the baseline in terms of financial stability from a regulatory approach has really improved, and that is very important in terms of being able to absorb adverse shocks. So I think the potential for nonlinearity, of course, there are lots of potentials, but having the core financial institutions being well regulated, is really important in our view.
Thank you, Tobias. I'm afraid that we have reached the end of our session. Please join me in thanking Tobias for his presentation with a round of applause.
Thank you, Tobias and Gaston. So, well, on top of uncertainties in global markets, central banks are faced with structural changes driven by digital revolution. In our second session, we will be exploring the important question, is there a role for cryptocurrencies? We have the perfect moderator for this session, Governor John Rawls, who has been the governor of the Central Bank of the Bahamas since 2016. Before this, John Rawls served as a financial secretary in the Ministry of Finance, and then from 2009 to 2012, Mr. Rawls was seconded to the executive board of the IMF as a senior advisor to the executive director for Canada, Ireland, and the Caribbean constituency. Please join me in welcoming Governor John Rawls and our speaker, Christine Parlour, who will be present her research in this timely subject. Please welcome to the floor.
Thank you.
I will show signs as to how many.
Okay. Yeah. I think you're. Yeah.
So, good morning to you all, and thank you, Anna, for the introduction. And let me say thank you again to our colleagues at the BIS for this very important conference, and to you, Tobias, for a great previous session. So now we're going to shift gears and turn to a topic of high interest for central banks across the region. And the question of this session is there a role for cryptocurrencies? And we're very pleased to have Christine Parler here to give us her research-based views on this topic. Christine is the Sylvan C. Coleman Chair at the Haas School at the University of California at Berkeley, and she's co-director of the Berkeley Center for Responsible Decentralized Intelligence. She's done extensive research on cryptocurrencies and decentralized finance, mining collusion, and the workings of automated market makers in decentralized exchanges. And she also teaches a massive open online course on decentralized finance. So today, Professor Parler will be drawing on her current research about the role for cryptocurrencies in areas like payments and clearing and settlement and trading. So it's my pleasure to hand the floor over to you, Professor.
Thank you very much. And thank you for inviting me to share some of my sometimes preliminary research. I guess the question is there a role for crypto? And as most academics, I will say maybe. But I think one thing that is true is that this is coming, and there's nothing we can do about it. And so it's useful just to think about what's coming down the gangplank. So what I wanted to do in this short period of time, I can't quite see the timekeeper, but, oh, I can't see you. That doesn't help much. Okay. So I just wanted to point out a few things. So one, I want to talk about payments, so basically stablecoins and how they're used. A little bit of digitization, but Hyun is going to presumably talk about it much more. And then talk a little bit about how some of the novel market designs that we see in crypto could potentially be incorporated into what we think of as traditional finance. So we've been looking at payment flows on the Ethereum blockchain. There are other blockchains, but this was just to get a sense of what people are doing. So on the vertical axis, you just have the number of transactions. These are in thousands, so there are not that many of them across time. And we have three different stable coins. DAI, which is crypto collateralized, so it's a completely native blockchain one. USDC, which is issued by Circle, so it's backed off-chain by collateral, and USDT, which is also backed off-chain by collateral. So the green is the USDT, right? How much money is being transferred? So as you can see, the amount of money that's being transferred by the USDC, which is the Circle-based US dollar coin, much, much higher, right? So the number of transactions are lower, but the volume being transacted is higher. What are people using these things for? So this is just USDT, so Tether, and basically it's broken down into three different segments. The top shows transfers or fraction of the volume that's going to centralized exchanges. So these are people who are putting in and out of crypto trading venues. The blue is going to DeFi protocols, so this is being used as collateral. And the green is user. These are people sending dollar amounts to each other, wallet to wallet. So the question is, how much or how pervasive is this? Well, we look at what we call periodic payments. So we basically look at pairs of wallets, and we say, okay, is there a systematic payment from wallet A to wallet B at some frequency? Right? And so on the y-axis, or the vertical axis, you see the number of periodic payments per day. Perhaps not that much, but it's useful that this is being used systematically. Once again, Tether is predominantly being used for these periodic payments. How much money is being transferred? And this is in millions of dollars on the y-axis. And basically, Tether, by far and away, is the largest way in which people are periodically, consistently sending and receiving payments. So this is being used as a proxy or being used instead of a traditional payment rail, right? So what do we want to think about this? Well, this raises a whole bunch of different questions. Pretty clearly, if you're using money through stablecoins, you're disintermediating banks. Banks are not, the payment role of banks, they have reserves or they have money sitting there, no longer happening. Is that a bad thing? Well, it's not obvious. It's not obvious that we want the same institution to process payments and also to make loans. To some extent, they're distinct categories, and the payment risk is presumably one of the reasons why we regulate banks so much. One of the benefits of stablecoins is they're potentially cheaper, and as we know with traditional payment rails, there are a lot of network effects that make competition difficult. So basically, maybe this could be a good thing. So it could encourage competition. One thing that's a huge distortion as these volumes increase is moving money away from the real economy. If all these stablecoin issuers are basically putting their money into treasury, what we're doing is we're having a transfer from presumably, small business lending or the other things that we think banks do to essentially investing in the government. And the question is, do we want to do that? And is that a good thing? And that, I think, is something that regulators should think about. There are complicated issues here, obviously. Going further, there are other things that have arisen that are looking a lot like banks. In particular, there's a movement to tokenize real-world assets. A lot of it has to do with reducing the costs of clearing and settlement and just making everything move more smoothly. What's in particular interesting is that people are tokenizing treasuries. So they go out, they buy an ETF, they tokenize it, and then they issue claims against that treasury. So effectively what you have is you have something that is pegged to the dollar. It is a means of payment, but it is also interest-bearing. That looks a lot like a bank account to me, and we'll see where it goes. There's a consumer one called Ondo Finance. They do this for retail. The BlackRock one, which is sort of interesting, has a minimum threshold of, so it's only for qualified investors. So you basically have to put in a huge amount in order to get one of these tokens that are issued on the Ethereum blockchain. People have been trying to use these as collateral in other sorts of traditional financial arrangements. And so now you're starting to get a huge amount of interconnected movement of tokens that I think would be useful just to think about very carefully. The other thing that I want to talk about, if I have time, is just some of the new institutional forms that are arising. I'm sure you've all heard of decentralized exchanges. The product Marianne was sort of useful. But one thing that's sort of very interesting to notice is that these are designed very differently. So the way that we regulate traditional exchanges when we think about what enhances liquidity, how we want things to behave, are very, very different. So these structured differently, they should be regulated differently. Interestingly, Uniswap has come up with a new version. It took us a long time to figure out V2, V3, but now we got V4. What is unusual about V4 is it allows people to develop customized on-chain trading platforms that have what are known as hooks. Hooks essentially are conditions that you can check before you allow people to trade. So you could potentially do this, make wallets whitelisted. You could potentially make sure that things have gone through a KYC process. So this is something that basically makes it really, really easy to move regulated assets on-chain. So something to think about. The final thing that I wanted to throw up, and of course I kept the most complicated thing for last, is something known as liquid staking. Liquid staking is what? So in order to maintain the consensus of the Ethereum blockchain, you basically need, under proof of stake, to essentially deposit collateral. That collateral generates returns, so there's a flow of value that comes from this staked collateral. The minimum amount of staked collateral is large. So a series of intermediaries, there are approximately 3 at the moment, have arisen that basically say, okay, you don't have a lot of Ethereum, so what you can do is you can give me your Ethereum and I will put it together and I will invest it in this illiquid asset, which is the staked amount on Ethereum. Okay. So, thank you. Effectively, you have something that looks like liquidity transformation. You have people who are taking a liquid asset, Ethereum, depositing it in an illiquid asset, which is this consensus value generation, and we go from there. The solution that people came up with, because people don't like having illiquid assets, is to do what is known as liquid staking. What does that mean? If you have a stake in one of these protocols, Lido in particular, what I'm going to do is I'm going to give you a receipt token. Now you take that receipt token, and if you want to cash out and eat today, you can sell that receipt token on very, very active and vibrant markets. So essentially what happens is you have things that are deposited in as illiquid claims that now are basically liquid. So this is, I don't know if you remember Jacqueline's critique on the bank runs, but he basically said if you had some sort of, instead of having a deposit contract, if you had something like a dividend-paying stock, well, basically, and you had a trade, a market where you could trade those stocks, then basically you could get rid of the bank run problem. This is what liquid staking is doing. So this picture basically gives you the staked ETH against ETH, and that's the blue line, and the red lines are basically withdrawals, and it basically says that the price between the deposit and the deposit receipt is it pretty much keeps its value. So this is something we're looking into. Just as sort of a broader thing, we started to sort of dig into this theoretically, and we basically actually think that having this liquid market can make the situation more volatile. And the issue is that markets do 2 things. They allow me to trade, but they also give people information. And the minute you have information and people are sensitive to that information, you can increase the probability of a run. So it's something that has to be looked at very, very carefully, especially if we move to a regime of digital deposits. Bottom line from all this. Automating finance, and this is what it is, right? So the crypto is basically automating finance. Provides opportunities for efficiency, no question about it. We have natural monopolies in a lot of the financial sectors, and so this is sort of a way of potentially giving gains to trade or gains to competition. However, it requires really, really careful regulatory scrutiny, and that is because the business models are so different from the business models that we see in traditional finance, and our regulatory structure is built to cope with the way things were yesterday, and they're going to look a lot different. Different people are going to be pushing different levers in a different way tomorrow, and that's something that we should think about really carefully. The final thing is inherent to any kind of cryptocurrency or digital asset is rehypothecation. Everything moves through, okay, I've got an asset, somebody gives me a receipt token, I move that somewhere else. Now we have interconnection between different protocols on a massive scale. And this is something that presumably or potentially has a potential for systemic events. So excitement, but also caution. Thank you.
Thank you very much. I have a longer list of questions than the time will permit, so I'll be very selective. Yes, first question, and then we'll get some questions from the audience if time permits. But the Bitcoin was cited as an example that was introduced to address payments and other shortcomings that were perceived in the market. But in practice, it's more of a speculative investment instrument. Do you see a future in which cryptocurrencies and decentralized finance play a larger role in the payment space?
So unless they're tied to the unit of account, they're not going to make any sense, right? The volatility is too high. I mean, the stable coins are the only ones that are going to be useful. I mean, in a world in which everything in the universe was denominated in Bitcoin, that would be different. But I don't think it's ever going to happen unless it's through stable coins.
Okay. Now, I was glad that you introduced staking on one of your slides because it has come up a lot, and the deposit-like characteristics. Should we be thinking about regulation from the point of view that in the mainstream we have deposit insurance, protection of depositors? Are they venturing into the banking space when this starts to happen?
So the similarities are obviously very, very clear. When it comes to regulation, I guess the question always is, what is the market failure? If we think that maintaining the integrity of these blockchains is sufficiently important from a systemic point of view, then yes, obviously you want to think about regulation. But if we think that this is something that people are doing on their own purview, then I would say not. So it requires a policy view on what we think cryptocurrencies are and how they should be integrated into the economy.
So I know that insofar as the technology is concerned, blockchain, tokenization, a lot of that is being adopted in the mainstream. But in terms of the product and other services gap that crypto was supposed to fulfill, have you seen, in your view, a meaningful or sufficient response from mainstream finance to address those concerns?
So in mainstream finance, there's a lot of like faux crypto activity. I don't know if you remember when there used to be massive returns to putting X at the end of stocks. There's a lot of sort of hoopla around trying to make people think that this is something new and something good. There hasn't been, as far as I can see, a complete integration of traditional finance with crypto. That said, there are a lot of, like Franklin Templeton, a lot of the large fund managers are seeing the potential of sort of automating the back end. And so they're viewing crypto as being potentially an interesting thing that they can be part of. So I think we'll see more of that.
Okay. So how do you assess the impact of the new U.S. administration's regulatory stance on cryptocurrencies and decentralized finance? Do you expect a regulatory stamp of approval for stablecoins?
I think, the new administration has said very clearly that they're crypto friendly. What that's going to mean exactly, we don't know. I mean, one of the issues in the US up to this point has been complete regulatory confusion about whether or not these are good things, whether or not they're bad things, who of the many, many, many regulators they fall under. I mean, other jurisdictions have been very careful about carving out digital assets and being careful about mining, who's holding them, and sort of providing essentially a legal framework for people, if they want to be serious about it, to enter into this space. So where the U.S. is going to go, I don't know. But I think, they're working towards having some sort of coherent regulatory framework, which I think will be a good thing.
Okay. So do you anticipate any impact on adoption?
Absolutely. I think there will be, if the U.S. comes on board and things start becoming sort of official policy, as you know, governments can push things in directions pretty quickly. And so if they're serious about it, I think there will be massive increase in adoption, yes.
Which means then that it accelerates the way we think about regulation, because then you have to be concerned about the level of sophistication of all of the new users in the
Absolutely, yeah.
space. And I think just judging from, some of your other work and the range of risk that are in these assets, it certainly makes a very interesting time ahead. I think we're going to have maybe 2 questions from the audience, if there are any. Yes. Just use the microphone, please. Yes.
I think the question I wanted to get to was the one that was just brought up, particularly with regards to information. One of the challenges of liquid staking is how do different protocols interact with one another? What's the sophistication, for example, of the users? And when you start to think about the technology and how one piece of technology, one piece of code sort of interacts with another, you get different kinds of transmission of risk on the one hand, and that sort of points its way to one kind of a regulator. But then you have, again, this user risk, the kind of consumer protection, informational risk that you get that's tied to all kinds of things that even traditional securities law doesn't necessarily anticipate, in part because of the technical features of the technology in question. When you try to sort of think through what regulation would even mean, and again, staking is a term of art more than anything else. There are so many different forms of staking, different platforms, different networks, and the like. But is there a kind of maybe a useful order of operations from a regulatory standpoint when trying to think through, how would you even begin to regulate? Because as far as I can see, it's not just a banking question, and in fact, it may even be a capital markets question first, and then you get to the banking stuff later. But if you have any tips, it'd be helpful.
Historically, the way regulation has worked for risky assets and not perhaps the most perfectly informed persons is by restricting the amount of money that they can invest. So that's sort of a tried and true way. I think providing information is also a tried and true way. So there are rules on, say, funds, what they have to disclose. You could think about all these things coming into play. There are a couple of what effectively are credit rating agencies in this space that provide code verification, and they provide sort of other information. That is, you could also think about that as being provided. I think one of the things that's particularly worrying about crypto is that regulation has to be done by international bodies because there are no boundaries. And so it requires a different way of thinking about how a regulatory structure should work. And that's like a really difficult problem. Yeah.
Thank you. Just one last question. Augustine?
Sorry to ask so many questions, but great presentation. Let me ask a more fundamental question. Do you think that a lot of the traction that crypto is gathering has to do with the fact that traditional finance and traditional money has not evolved at the speed of technology and responding to what people need? So let me put one way. I mean, if we had, for example, a wholesale central bank money or reserve currency, technologically advanced, do you think that that could make up for the demand of stable coins? I mean, for example, stable coins, I mean, one of the reasons why I don't like is that when you talk about money, if you need to put as a previous adjective stable, that tells you that there is something wrong there.
Yeah.
Or there is some vulnerability there, no? Now, stable coins are backed by US treasuries or by cash, which at the end of the day is the real thing. So shouldn't we concentrate more on making the real thing, to be able to be represented technologically in such a way that the space that stable coins or crypto is filling would be filled in a more solid way? I don't know if my question is clear, but
it all comes down to trust. So if you have a world where everyone trusts Tether and everyone uses Tether to make payments, it's very difficult to see why anyone would switch at this point to something that is issued by one central bank. If it is in fact the case that these stable coins are used internationally, then why should I care about central bank A when I'm in jurisdiction B? Why not just take this large international company that seems to be multinational and doesn't seem to have sort of strange biases? So I think at this point it's very, very difficult, or it will be difficult, for central banks to come up with some dramatic exceptions, central banks to come up with a widely adopted stablecoin that basically could overtake things like Tether.
Thank you very much, Christina. I think that's an excellent note on which to end the session. We appreciate your presentation. Let's give her a round of applause. And Anna, we will turn things back to you.
Thank you.
Well, welcome to our third session. We will now turn to talk about tokenization. My dear colleague Hyun Song Shin will talk about tokenization and the financial system. Hyun is the head of the Monetary and Economic Department at the Economic Advisor of the BIS. He's also a member of the BIS Senior Management and its Executive Committee. Before joining the BIS, Hyun was a professor on Princeton, LSE, and Oxford. So he combines the rigor of an academic with the practical bent of a policymaker. Please join me in welcoming Hyun. So Hyun, then come with me.
Well, thank you, Anna. Thank you for the very nice introduction. Very good to see everyone. And what I'm going to say is going to fit perfectly after what Christine has given us. And in a way, it tries to address what Agustin asked at the end of the session, which is, can we think about the functionalities that come from crypto, but in the regulated financial system? So just a little bit of historical background is useful. If we think about the evolution of money, it's always been spurred by developments in the real economic activity itself. So if we start off with commodity money on the left-hand side here on the slide, I guess we can say that the big advance in the institution of money was the advent of money in the form of entries maintained, entries in account ledgers maintained by trusted intermediaries. The central banks are really the best example of an intermediary. And commercial banks are customers of central banks, and central bank just debits one account and credits another account. So this institution has been around for several hundreds of years. But I guess, in the old days, they were actually literally paper ledgers. You had to write, you had to cross out and then write, new entries. Of course, in the 20th century, all of that became digital. But the underlying rationale was exactly the same. So rather than writing with pen and paper, it's just zeros and ones. I guess what Christine has also shown us is that there is an additional element, and this is the element of tokenization. So tokenization has many different aspects, but the best way that I think that I could understand this is to say it's not only a digital record, so it's not only an account ledger entry, it also combines the rules and logic that governs the transfers. In other words, you can program the digital entry in such a way that you can have the contingent performance of actions. In other words, you can have these if-then statements. So if various conditions hold, then certain activities take place. So the most talked about application of this is in the case of securities markets, which has to do with payment versus delivery. So I would like to sell a security and receive money in return. The buyer would like to buy the security but pay in return. There could be settlement risk, which is, given the sums involved, that could be very, very important. And we would like to mitigate that settlement risk. And one way of doing that is to write a program that says the money goes out if and only if the security comes in. And that's that's the canonical example of how you can use the contingent performance of actions in mitigating risk. Now, of course, tokenization is not the only way of achieving payment versus delivery. We have built up whole institutions to deal with that. And I guess what that shows us is that if an issue is important enough, we will always build institutions that actually take care of that. And I think the issue with tokenization, I think, goes well beyond payment versus delivery. So although that's the canonical example, I think it goes to the heart of this issue. Well, what else can we do with this? And crypto, in a way, has shown us the way. But one thing that Christine didn't mention in her presentation was central banks. And central banks, after all, issue the unit of account, and it's really the focal point of the monetary system. I mean, it really is the foundation of the monetary system itself, and it ensures the singleness of money by settling transactions, across different customers of different banks. And one idea that we laid out in our annual economic report 2 years ago was the idea of a unified ledger, where we not only have central bank money together with commercial bank money, but also with other claims on the same programmable platform. Now, that could be decentralized using DLT, or it could be a bit more centralized, as long as we have the governance that backs it up. The technology really is secondary to the idea that you have all of these instruments on the same platform. And the key here is by providing central bank money in tokenized form in the same venue as these other claims, you can actually give full flow to the functionalities of the flow. And actually having public money in this kind of setting is going to be absolutely crucial in order to have the singleness of money and the public good nature of money really providing the benefits. So I think the first use case, which I'll come back to, is in securities markets. But let me give you a second use case, which is something very concrete and something that we're actually doing at the BIS. The picture you see here is the Bank of Amsterdam. Bank of Amsterdam arguably is a very early version of a central bank, in that it actually issued fiat money in the very early days. Customers were merchants, just like commercial banks are customers of central banks these days. In the days of the Bank of Amsterdam, merchants were also the bankers, hence merchant banker. And the Bank of Amsterdam played the role of a central bank, a sort of proto-central bank. And what we're trying to do in Project Agora is to really harness this programmability to do something that we do already, but in a much better way. And so what we have done is to assemble 7 central banks, and that includes the issues of international currencies like the dollar, euro, yen, sterling, and Swiss francs, together with the Mexican peso and the Korean won. So there are 7 central banks. And we've teamed up with 41, and that number sort of varies from time to time, but it's over 40 private sector institutions, mostly commercial banks. And what we're going to do, what we're trying to do is to provide the next generation platform for correspondent banking. So correspondent banking, as you know, is, if you like, the backbone of the international monetary system. And as I said earlier, the key innovation in money is the idea that you can send money by debiting one account and crediting another account. Sometimes that's on the books of the central bank. In the case of correspondent banking, it can be on the books of a commercial bank, a large commercial bank that has international business. And the idea is that we can actually send payments across long distances by having a sequence of these account transactions. So, in this case, suppose that we have firm A that's in the US, firm B, let's say, is in Mexico, or actually, let's say Korea, it's further away. And then we have a sequence of these account transactions. You debit one account, you credit the other account, and then at some point there's also going to be a currency transaction. The problem is that this kind of system is virtually unchanged since the days of the Bank of Amsterdam. So correspondent banking grew up in an era where you relied on the trust of the intermediaries, and the payment system was just the flip side of the trade relationships that existed between merchants. The problem is that we have now grown well beyond this, especially given the compliance requirements. So AML, KYC, all those requirements have been layered on top of a set of institutions that were not designed to handle that kind of burden. And that means that correspondent banking has really been retreating. Now, what Agora tries to do is to say, well, rather than have these payments sequentially, why not just harness tokenization? This is going well beyond payment versus delivery. Why not harness tokenization and have all of these account updates happen at the same time? Just one update all the way through, and because of the programmable nature of the platform, you can harness the latest AML, KYC utilities that use privacy-preserving techniques to do the compliance checks all the way through. And this is a very concrete application. Now, let me just conclude with a couple of thoughts, and I'll come back to the securities issue. Now, there are other applications, and in the early days of this discussion, we had many advocates point out that issues like supply chain management or real estate transactions are really the prime cases where you can harness tokenization to have efficiencies. But if you think about those kinds of operations, there are many, many moving pieces and many dependencies. That means that as soon as you have a set of players that you need to bring onto the platform, you can immediately think, well, there are half a dozen other players we need to bring on as well. With supply chains, it's not only the shippers and the bankers who have the letters of credit and so on. Think about the warehouses and then the official sector as well. And then as soon as you have a set of players that you think would be sufficient, think, we forgot about X and Y, so we need to bring them on. And then if you have X and Y, for them, there are other players whose actions are going to be important. Same thing with real estate. There are many, many steps involved in the conveyancing process, and it's going to be very, very challenging to pull this off. So there is this, this trade-off in that the bigger the potential benefits, the harder it is to actually make tokenization work. I think one of the things that we've learned looking at this issue is that the most promising use cases are those cases where the applications have to do with the update of account ledgers. And correspondent banking is the classic case, but the securities market is also very, very close because centralized securities depositories, or CSDs, are also account ledgers. If you can have the updating of the accounts interlinked with the payments, that's going to give you a tremendous efficiency gain in terms of capabilities. And I guess relative to what Christine has provided, I think this idea that we have central bank money at the heart of such a platform means that you can actually build much more securely. And then if you have central bank money, then commercial bank tokenized deposits in some ways are a much better way of fitting the pieces together. And we can discuss stable coins and how they might differ here. But I think the third part of that trilogy with government bonds, I think would actually complete that triangle in a very nice way. So why don't I stop there, Anna?
Thank you, Hyun, for this very interesting presentation. Let me open the floor and gather some questions from the audience. There is one here, Julio.
Hi, very nice talk and the summary of the report that you had in 2023. I have one basic question that my understanding is that a lot of the drive between tokenization and cryptocurrencies has to do with decentralized finance, which in a way tries to move away from central channels and away also from government intervention. So there's a liberal type of, or libertarian type of approach, no? So in a way, some of the examples that you give brings back the role of government of some official institutions. How do you reconcile these two views?
I think that's always a very interesting tension in this area, and I don't know whether Chris Brummer is still here, but Chris and I have had many discussions about this. I think in terms of the functionalities, I think there's a very broad continuum, and I think the reason why having central bank money there at the heart of this kind of project is such an important aspect is that we can preserve the best of the current system, especially having central banks who are effectively guardians of the monetary system itself, being there, ensure the singleness of money so that even if you bank with different commercial banks, a dollar in your account is a dollar in your account. I guess maybe I can just spend 1 second on how this would differ with stable coins. I think with stable coins, they are bearer instruments in that they go back in a way to the commodity-based money that really is at the heart. And there's a broad continuum here with the debates about narrow money, so the difference between currency versus deposit money, where currency is, if you like, it has to be backed. It is hard money. It is narrow money. And I mean, there's a little bit of a difference, I think, with Christine's presentation, in that with commercial banks, we know that yes, they are the core to the payment system, but there is a reason why they have played that role, because going back to the merchant banks of the Bank of Amsterdam, they're a very important liquidity provider as well. So if you have a long supply chain and you want to make a time-critical payment, overdrafts and lines of credit really become a very, very important part of the payment system itself. And for manufacturing firms, for example, we know that undrawn lines of credit are larger than drawn lines of credit. That really has to do with the liquidity provision role of commercial banks. So in that respect, I think there's a lot in the current system which has this elasticity, this liquidity provision role, which is lacking in the stablecoin world. And I think this way, our way of doing it, would bring back the benefits of liquidity provision role of commercial banks.
Let's see if we have another question from the floor. Yes, Oton?
Thank you, and thank you for the presentation. Going deeper on what you just commented on the nature of the bearer assets of stable coins and tokenization of commercial bank money, which differs in the sense that it's still a ledger with all the niceties that added to the token. When is going to be relevant for the trilogy you talk about having central bank money, tokenized deposits, tokenized government bonds? If I change tokenized deposits for stable coins, losing this characteristic of the commercial bank money and replacing it by the bearer asset, where is going to be relevant for the efficiency of the trilogy?
So I think you have to imagine how a system would look like if you had stable coins. So, currently when someone sends you money, if the sender banks with a different commercial bank, what happens is that the sender's bank debits that account, my bank credits my account, and in the background there is a settlement through the central bank balance sheet. So it's not that I acquire a claim on the sender's bank, my bank credits my account. A stablecoin works differently in that if I receive a stablecoin, that has the name of the issuer attached to that balance. So when I wake up and I check my balances, I would have 10 red dollars, 10 blue dollars, 10 yellow dollars, and they're very different. Well, they are different in that they are issued by different issuers, and in that sense, we are departing from a world where money is just money, and there is singleness of money. And this is going beyond, this idea that the banking sector provides, liquidity as a core part of the payment services. A world with stable coins is the one where you have the cash in advance constraint. There is no such thing as an overdraft there, because a stable coin cannot, do banking services in the way that banks do. And so it would be very much like the kind of narrow banking model. So if you had narrow banks that do not provide loans, together with, let's say, private credit firms that do provide loans, that would be the kind of system that we would gravitate towards.
Okay, thank you. I think we are just in time for finishing this very nice presentation. Thank you, Hyun. Please join me in giving applause to Hyun. Okay, now we will now have a coffee break. Please, we will reconvene at 11:30 for the next session. I would like to ask the panelists for the next session to come straight to the stage after the coffee break. Thank you and enjoy your break. Welcome back. Please take your seats. Go ahead, take your seat. So, thank you for being back. Our next session is a panel discussion on payments integration in the Americas, a critical topic for regional finance cooperation. Faster, more efficient, and secure cross-border payments have significant potential economic benefits. Central bank digital currencies could help facilitate this, but there are many other aspects to be considered and discussed. So we are here for that. Our moderator for this session is Cecilia Skinsley, the head of the BIS Innovation Hub since 2022. The BIS Innovation Hub is actively working on various technological solutions for cross-border payments. And Cecilia is a member of the BIS Executive Committee, and previously she was first Deputy Governor of the Riksbank. Welcome, Cecilia. Please join me in welcoming Cecilia and our panelists here at the stage.
Thank you very much, Anna, for the kind introduction. I can say that it's always a bit of a challenge to be the session between the audience and lunch. And food here in this country is fantastic. But this is a very eager panel because they were all waiting for me. I was the last one up on stage, so they're really keen to get going. And they promised me a really rich discussion. So time will fly and we will learn a lot. As we heard, the topic is payments integration in the Americas. Maybe we should add digital payments in payments integration. This is a region, I can say that traveling a lot in the world as I do, that is impressing other countries and is seen as a role model because it has made important strides in developing domestic fast payment systems. We know that Latin Americans with a bank account, which is an important qualifier in many countries, Latin Americans that has that can now make standard-sized payments cheaply and quickly around the clock. But unfortunately, much less progress has been made in the cross-border payments area, which still tends to be much slower and more expensive than domestic payments. And here we're primarily thinking about retail payments. So in this panel, but not only, in this panel we will explore why this might be the case and what we could do about it. So let me introduce our panelists, starting on my left side. Gabriel Galípolo has been governor of the Central Bank of Brazil since the beginning of the year. Before, he was deputy governor responsible for monetary policy. He joined the central bank in 2023 after a distinguished career in the financial sector, academia, and government. Next is Roger Madrigal, governor of the Central Bank of Costa Rica. Roger looks back at a long career at the central bank, including as its chief economist. Lorenza Martinez next is Chief Operating Officer of Intercam. Intercam is a Mexican bank, especially offering service related to nearshoring. Lorenza assumed her current position in March 24 after serving as the CEO of Banco Actinver. Did I get that right? Yeah. Thank you. For 3 years. Before moving to the financial sector, Lorenzo also had a successful career at Accenture, the Bank of Mexico, and the government. Well, last but not least, Anderson Caputo is Chief of the Connectivity Markets and Finance Division at the IDB. Before moving to his current position, he worked at the World Bank and the Brazilian Treasury, focusing on issues related to capital market development, among others. So we will begin the panel with initial remarks by the panelists. I will then take the opportunity as the moderator, ask you a follow-up question each, and if time allows, open the floor for additional questions. So it's a great honor for me now to give the floor to Governor Galípolo, and then we'll follow by Governor Madrigal, Lorenza, and Anderson. Please.
Thank you very much, Cecilia. Thank you very much, you all.
It's not only hard come before the lunch, but also after such great presentations as we saw here. Thankfully, I don't see Tobias here, so I can escape the question that he made to me. This is the first day after blackout period in Brazil, so if I cannot answer that question about monetary policy, I avoid creating any kind of commotion in the market in Brazil. But going to the topic, first of all, I would like to thank the BIS for the invitation to speak about payment integration in the Americas. Payment integration has a huge potential to facilitate cross-border financial transactions and international trade in region. In fact, financial integration has been at the core of the innovation agenda that the Banco Central do Brasil has implemented over the few years. The main innovation projects include our instant payment system, the PIX. As you know, people from the Central Bank of Brazil are justifiably accused of talking too much about the PIX, but we like to talk about the PIX a lot. The Open Finance and the DREX. The DREX is the kind of central bank digital currency of Brazil, and I said kind of because it's not exactly as we used to conceive a central bank digital currency, and we can return on that topic later. From the beginning, we recognized the need for a public good solution to support the implementation of a fast payment system in Brazil. The idea of developing a fast payment system had existed at Banco Central do Brasil for more than 10 years. So the first vote approved by the board on the topic dates back to when my friend Tombini was still governor. So for more than 10 years, we started discussing this. The obstacle to its development came from resistance by incumbents who already provided solutions that involved fee charges, so a fast payment system would require new investments and the prospect of loss of revenue, given that it would be free of charge. This compounded by the absence of popular demand for a solution in this area, given the diversity of other needs that Brazilian society presents. Therefore, in addition to relying on the excellent technical capacity of the Banco Central do Brasil staff, and factors such as the social distance imposed by the pandemic, which possibly acted as a catalyst for the development and acceptance of the PIX, political will was also required. As I said, I know that the Banco Central do Brasil are often accused of being monothematic and talking excessively about the PIX, but this long introduction aims to underline the central message of my speech. The creation of a critical mass of users and network effects was crucial to the PIX success. For this purpose, the Banco Central do Brasil had to use its legal mandate as a payment system regulator to force large institutions, those with more than 500,000 accounts, to participate in PIX in order to create a critical mass to users. Thus, we created the critical mass through regulation. While about 30 institutions were initially required to participate in PIX, more than 700 other institutions joined PIX voluntarily. As a result, PIX not only increased competition within the Brazilian payment sector, but also met the demand for a fast, cheap, easy, and secure payment option. And given its programmability, PIX has the potential to enable integration with international instant payment systems. Today, technology is no longer an obstacle for this interlinkage. Each country can have its own fast payment system, and technology can connect different instant payment systems in different ways. Globally, the G20 and the CPMI have done a great job in developing a roadmap for cross-border payments. This roadmap encompasses a plan to make cross-border payments faster, cheaper, more accessible, and transparent, addressing a key challenge and frictions. Within this plan, a conceptual work stream that could yield improvements in the medium term for cross-border payments is the interlinkage of fast payment systems. However, there are still governance issues that hinder cross-border payments and the integration of international fast payment systems. Countries today have different rules, for instance, for taxation and money laundering and combating the financing of terrorism, and for the identification of the final beneficiary of transactions. To integrate international payment systems, we need to establish a level playing field with minimum common rules for cross-border payments.
Any jurisdiction that wants to participate would have to adhere to the set of rules. As I try to highlight, it is important to bear in mind that these benefits depend on a critical mass of users and transactions, as well as a network effects for the ecosystem to gain traction. In the Americas, the US and Canada account for the large shares of incoming and outgoing remittances. Therefore, the impact of any initiative for fast payment system integration in the region aimed at reducing the costs and improving speed heavily relies on the connection to a private or public fast payment systems solution in the US and Canada. To conclude, at the Banco Central do Brasil, we believe that technology not only brings efficiency and modernization, but is also a primary instrument in propelling financial inclusion forward. Thank you.
Thank you very much, Governor Galípolo. We continue immediately to Governor Madrigal. Please, the floor is yours.
Good morning. Thank you very much. Thank you, Mr. Alexandre, for inviting me. Thank you, Don Agustin. I'm going to talk about a little bit about SIMPE in Costa Rica. SIMPE is the payment system in Costa Rica. We have some fast payments. It depends on the device that we use. Can be used by the traditional banking. You go to the websites, but also using the telephone. The one we call SIMPE Mobile. Financial integration and financial inclusion has been the result of the development of the payment system, not in the other way around. As my colleague from Brazil says that they haven't that in mind. We didn't have that in mind. The only thing that we have in mind was efficiency, to make this faster, cheaper. Some characteristics. Something that I have said before going through this. I will say that SIMPE is well developed, mature for the local payments inside the country. But we have not done too much about cross-border payments. This is still a huge challenge for us. Okay, more or less, more than 91% of the population, 15 years and older, use SIMPE. They have a banking account in Costa Rica. So this is a huge, in Latin American terms, financial inclusion. We measure that by who has these official accounts in the financial system. The fast payments, they are done in less than 1.7 seconds. There is no limit established for the central bank. Are the banks, the provider, the intermediary, the financial intermediaries, the ones that set with their clients, their customers, what is the limit? It's available all the time, 24 hours, 7 days a day. The settlements is we call gross settlement, is real time for all participants, totally automated. It means that once that you give the order to send the funds, there is no human intervention until it gets to the destined, the final user. There is a verification process that is before the confirmation of the payment, and he's running into some frictions with the settlement currency. Is only for for exchange intermediaries. It's not for the general population. You can do transfers with other currencies, foreign currency, but for the fast payments, it's developed only for the local currency. We use the International Standard Bank account, the IBAN. All the accounts has a number, IBAN accounts. It was a surprise for us. That was something very well known, for example, in some parts of South America and Spain, but not in the US. I think that they are now in this process. The standard messaging is we developed our own, but now are in the process to comply according to the ISO 2022. There is this process of the know your customer to avoid money laundering for operations that are $10,000 or more. The fees that the central bank charge are very low to the intermediaries, but every intermediary will negotiate with their customers what is the fees that they will charge. As I said before, there are support for technical support and attention to the users, the 24 hours a day, the 7 days of the week. Now, this is more what we hope to be, and some challenge that we have with a cross-border payment. The first thing is governance. Who will coordinate that? No, we cannot impose our standards to other countries. It's something that somebody else, or we need an agreement, some legal backup on this. What are the rules of the system? Also, there are a lot of operative issues. Some of them has to do with the time zone that we are. And also there are technological issues like interoperability, the messaging standard that I talked a few moments ago, how we make the interface of the interlink with systems like SWIFT or other private networks. We need to have rules for business continuity, and the other big problem that is cybersecurity. Of course, the challenges that anti-money laundering and financing terrorism are higher with the cross-border payment. So it's something that we have to look at. This is the reason we need this international coordination. It's something that cannot promote from our side. I have to say that many of these things, there is a need for some cross-border payments. Costa Rica is a very friendly country for immigration. Actually, we give some form of identification to the migrants. We have a population like maybe between 12 and 15% of the population are migrants. So the first thing that we like to do, but it's up to them, not up to us, to give some form of identification so they can open an account in a formal institution, in a formal financial entity. This is one thing. The other thing, we are a small open economy. We maybe is our third commercial partner, the whole region. So the regional banking service do some of these fast payments, but this is a solution only for the region. Also, we have something called SIPA. This is an initiative of an entity called Consejo Monetario Centroamericano. It's working more or less. It works better for some countries than others. Part of the problem has been the standards. Has maybe 15 years of existence. They don't have too many transactions so far, but it's picking up. But there are the solutions that the real economy is looking, because they don't have this well-developed system of cross-border payment. I will stop here.
Thank you very much, Governor Madrigal. We will come back to the great achievements you've done a little bit later. Let's move to Lorenza Martinez from Intercam. Please, the floor is yours.
Thank you, Cecilia. Thank you for the invitation, and congratulations for such a great Congress. And I should emphasize that the order of the presentations, I think there have been very well thought in terms of how it has been introduced, the different aspects of technology, tokenization, before this panel in which probably this technological new aspect and issues of stable coins are in the air, especially for cross-border payments. I want to emphasize the importance of the relevance of cross-border payments as the backbone of any economic integration. It might be migration, international trade, but so it helps, but it also an additional friction that might have any transaction between countries. So there has been a growing evidence that the improving cross-border payments would have in terms of not only international trade, but also in development. Actually, there is a paper by the IMF, it was published June this year, in which they explain first the under trade, given the regional aspects of LATAM. And the main aspects are the lack of infrastructure or infrastructure gaps and low quality of governance. But they also find that improving cross-border payments might have a significant and a positive impact, not only in international trade, but also on the development of the region. So this is probably very obvious, but I think that having this evidence helps to put this topic on top of the agenda, as it has been in the BIS, and as it has also mentioned for the G20. In the G20 agenda, a priority has been to improve cross-border payments. And the way they think of improvement cross-border payment is by making them faster, cheaper, and more transparent. And I think that all of us agree that these are probably the main characteristics that can describe a better payment. But I would also want to mention, probably not that these characteristics might be more important, but considering how fast is changing the payment landscape and the role that technology and digitization is having on payments, it's very relevant that we think also in other characteristics that the consumers or the users of payments are now valuing a lot. So we should consider that the user experience, the access of the technology or of the payment, the additional systems or the additional services that a service provider can have are becoming much more important. And for some users, those characteristics might be even more relevant. And as the diversity of users are increasing, or the market is focusing on the specific needs of the different segments, that's something that we have to keep in mind whenever we think on improving the payment system. So, and in that sense, all these actions or agenda that is going in improving infrastructure, I think that helps in reducing this cost or improving efficiency, reducing cost, but also allowing the participants to be to have a flexible offer of services. So before going to what is going on, what has been done, or where are we in this effort to improve integration of payments, specifically in Latin America, I want to mention some numbers that come from SWIFT that also tell us that even though the region doesn't have all the cross-border payment that it should, it's not only cross-border, as I mentioned, it's also international, but it has been improving. For example, in terms of the speed of the payments, the G20 agenda aims for the 75% of cross-border payments to be credited to the beneficiary within an hour by 2027. Globally, we see that 90% of the payments are delivered between banks within an hour, and 43% are credited to the beneficiary. When we go to LATAM, these numbers are 95%, so between banks is even it's a higher percentage of payment in LATAM, and 40% going to the beneficiary, so a little bit lower. And in Mexico, we have even better numbers. We have 97% of the payments are credited between banks in lower than an hour, and 46% to the beneficiary. So there's still a lot to go to have to achieve the 75%, but we are in progress. Regarding transparency, and also taking the numbers from SWIFT, in Mexico, only in Mexico, 25% of the operations are tracked until creditor, until it's credited to the end beneficiary. Only 25% are not tracked. And, but this shows a big disparity or big deviation within different banks. The most efficient banks track all the payments except 9%. Only 9% are not tracked the whole process. So it's again moving in the right direction, but it's still far from the objective. In terms of what to be done or what are the main building blocks to go to these objectives, the G20 has 19 actions or building blocks, but in different areas there have been the emphasis in three, the most important. The first one is the regulatory and supervisory frameworks. We all know, it has already been mentioned by Gabriel and Roger, all the regulation in terms of AML, in terms of other type of regulation, is a big friction for cross-border payments. The second is the data exchange and messages. So if we need, for regulatory compliance, one of the most important elements is information. So if we don't have a good way to exchange information and be able to share this information, then that's another difficult thing. So the second one is this data exchange. And the third one is payment system interoperability, which is like the biggest achievement, but we need the first to have solved the first two, or have an agenda on how, or a scheme on how to address those while doing the payment interoperability. So how are we moving to attack these three main building blocks? Well, one is the SWIFT is working in the implementation of the ISO 20022, which is, for the ones that are not familiar with this payment, it's a standard message, and what it's very valuable of this standard is that the information has to be both of the beneficiary and of the issuer of the payment, has to be in very specific fields of the payment. Mm-hmm. And this makes a huge difference for the different institutions involved in a payment, because as of today, the information might be in the message, but it might be all over the place. Even though there are specific spaces, they are not comply with that. So to automate payments becomes very difficult when there is not a standard of information. So the ISO 20022 should be implemented by end of this year, and I think this would be a huge improvement on cross-border payment. And the other one that I wanted to mention, and that's why I said that I like the order of the panels, is what John Oswald just mentioned, the Agora project, which is this project to integrate, to have an integrated platform for cross-border payments. And I don't have all the time to explain it from the side of a private bank. So my bank is part of this initiative. We are participating there. And one of the elements, it has a project that has been very well thought in the different aspects. But one, I think, is this work together of all the stakeholders to make sure not only that it makes sense from the standpoint of having a good infrastructure and an infrastructure that works, but also that it's an infrastructure that is going to be implemented by the different commercial banks that at the end are the ones, commercial banks are probably later on different institutions, they are the ones that are closer to the users and are the ones that have to be giving the service to the different business or consumers. So I think this is now limited to the development, but we are very optimistic that this will go in the right direction, and this might be something that for the Latin American region might be also very helpful. So I think I stop here.
Thank you very much, Lorenza. Let's move then to Anderson Caputo. Please, the floor is yours.
Thank you very much, Cecilia. I think it's fair to say that I'm going to be saying a very fresh good afternoon, no? At the time I was saying to see you. But I wanted to really thank for this invitation, beyond a normal, regular type of invitation, but it's really how we value at the IDB, thanking Agustin, Alexandre for the invitation, but we value this partnership and the synergies that we can construct between BIS and a development bank focus in the region. And we find this extremely valuable for the mission that we have in terms of development. And as you see, I think that there is a complementary angle here that my focus will be really with this development bank lens on supporting development in the region. And then more specifically, the angle that this has with one of the main goals we have, which is fostering financial inclusion in the region. And that I think that the key message that I really want to pass is how we see all that we're discussing here as a tremendous opportunity now to move really in a very deterministic way and reach results in terms of financial inclusion with what's happening here. No? I think that we have a tremendous opportunity, but I'm also excited to be speaking here in the context of what has proven to be an invaluable partnership already that we are doing IDB, BIS, more specifically with the Innovation Hub, led by Cecilia, who is moderating the debate. A huge partnership. I see Baltazar over there, that we are working really on a daily basis. And together with the participation of the Central Bank of Canada, we have been working on this project that's called FUSE, the Fully Scalable Settlement Engine, which is a back-end infrastructure that can be adapted to multiple types of infrastructures, payment systems being the focus. Now, FUSE is a regional public good, open source for regional central banks. I was telling Baltazar before this that don't ask me about the technology. The technology, he answers all the, but it's really this complementarity that we bring on how in our relationships with the central banks in helping them assess the current stage of things, regulations, etc. We find the complementarity so rich in the partnership that we have. No? And in that regard, just to shed some light on the opportunities. No? The opportunities in terms of financial inclusion, you can see that in several dimensions. If you look at the level of individuals, there has been a tremendous progress when you see in terms of access to financial services account in the region that grew from 51% to 73%. No? So that's not really the main thing. This is very welcome, etc. But there are differences when you look with really closely in this access, in terms of access and use, in terms of human women access, the elderly, and the poorest populations. No? So there is an important angle there for us to be looking at. Now, and then when you look at micro, small, no, and medium enterprises, also persists tremendous barriers in terms of access to credit. Now, in the finance gaps reach a third of the GDP in the region. No? So when you look into these developmental angles, that's why the opportunity is so immense. No? And in the agenda of financial inclusion, when you're discussing financial inclusion, we always make the link to payments, no? As one common element on some of the key items in the agenda. Like when you're discussing access in the last mile, MSME financing, now, or like a concept that is being very discussed now, which is the concept of financial well-being. In terms of last mile, that was also a key theme prioritized in the G20. Now mentioned, by the way, the paper of the IMF is great. I'm glad that you mentioned there. I'll mention another great paper by John Frost in this topic here, in the context of what I'm discussing. But so payments are really, as the primary enabler to access and use of financial services, and the financial technology are really key to achieve such last mile access. No? And we have been, like in this experience, working, we see, for example, the case of Colombia and Ecuador, that we were working and supporting, now to some degree, that they have created digital public infrastructures and policies that are conducive to this goal. No? For MSMEs, part of the solution to close the financing gap is the richness of the data in enterprises that are taking part in the financial system through payments feeding such infrastructures. No? So we know that fintech is key enabler of MSME financing, and also recent experiences that we observed in Chile, Colombia, where regulation has enabled fintech. No? Are steps and factoring policies are steps in this right direction. No? And finally, I mentioned the financial well-being as a key theme. No? This is defined as a state in which individuals can smoothly manage their financial needs and obligations, cope with adverse shocks, pursue aspirations, goals, and capture opportunities, feel satisfied and confident about their financial lives, considering country-specific. But all these are very nice, but all these, like a precondition for all this happen, again, is to have that access to financial services, where, again, payment systems have a central role. So what the message and the way we see as a development bank is that we are seeing here the region witnessing this transforming presence of digital payment systems that are immediate, interoperable, based on the needs of users. We have examples of Brazil, Costa Rica, Mexico, Paraguay. And then, as I mentioned before about John Frost, one key message that I wanted to mention, and why I like so much the paper that he wrote and then getting evidence, is the evidence of the responsibility and role that we can play here, that central banks have, like when you look into the governance of these payments. I think that the example of Brazil is very clear, that Galípolo was talking about how relevant it was that Brazil, like the central bank was now for adoption, that the central bank was so much involved in having a key role. So that's why I believe that this partnership with the BIS is so promising. Working together, we can try to bear the fruit that this can have in terms of financial inclusion in the region. So that's my start. Thank you very much, Cecilia.
Thank you, Anderson, and let me reflect that we are equally very happy and satisfied with the collaboration we do on Project Fuse. So watch that space, what we're doing in that project. So I'm going to open the floor, but I'm going to take the opportunity to ask each panelist one question. I'll take the opposite direction. So starting with you, Anderson, you did talk about the need for better payment integration, but could you a little bit more unpack what potential you see in that space, and the connection between better payment integration and catalyzing financial inclusion? What you see from your vantage point?
Thank you very much, and it's very good to be in the end, because it makes a good connection with what I was saying before. In terms of again, development bank, and with the lens in the objective of financial inclusion, we think that cross-border payment systems integration has the potential to be really a game changer for financial inclusion. Reducing the costs, increasing efficiency, expanding access, now can empower individual enterprises, and to a large extent, the economies across the region. But the message here is to think, like, what is the path that way? Now, it requires a lot of work, a lot of collaboration. But we think that the first step is the development of local fast retail payment systems is critical in that regard. No? It has been our motto at the IDB Group to foster financial inclusion through developing these fast retail payment systems at the local national level as the first step. Now, but we have one tool there in the IDB, which is our FinTech Reg Map tool, now that we can see the stage of each of the countries. And only 9 out of 26 member countries of the IDB have put in place a regulation for fast retail payment systems. No? So we consider that there is a good opportunity and starting point. No? And we have also looked at all these very similar way as I was mentioning about the complementarity we have in this partnership with the BIS, that you need like a triad of actions. No? First is that you need to have appropriate public policies which include a suitable regulatory framework to enable fast retail payment systems. Then you have the institutional aspect. No? Enabling institutional capacity, understood as the necessary institutional architecture and talent at the central banks and other financial authorities. And third, we talk about the technology, the creating the digital public infrastructures, financial technology, and supporting current market infrastructures so that you can create access to payments, foster standardization, et cetera. No? And that's why we are talking about this project FUSE so much, because I think we find there all these 3 elements. Now you have the technology, like a BIS together with Central Bank of Canada. They're very advanced, 95% developed. No? But besides the technology is this work that we do now with regulators, as I mentioned a few examples here, both in the context of assessing the stage of regulations, but also preparing central banks for this task. No? But then we move to developing these local fast retail payment systems allows you in doing so to several aspects that will be key for integration. No? Some were mentioned here by Lorenza too, like the fact of standardization and interoperability that needs to be there. Like you're planting the seed, no? Swift and efficient settlement. These are all actually, by the way, points that I borrowed from the paper you mentioned, but we fully agree. No? And minimizing settlement risks with clear rules, no? Transparency and disclosure. Not transparency, like we mean information on fees, exchange rates, processing times. No? Adequate incentives, I think it's a very important one, for private sector collaboration, innovation. No? And so to be closing here, like to sum up, integration is possible indeed, no? But I listed here a series of things that you need to get the work done. No? For payments integration, we need that triad that I mentioned of having the digital public infrastructure, but having the regulation, the institutional capacity at the local level, now with fast retail payment systems that are standardized, capable of communicating with any external counterparty. But we also need one thing that I didn't mention so explicitly, but this is important for regulators, is to create now the space to test innovation in controlled environments so we can prove their potential. And lastly, we need to create a public-public and then a public-private network to reach agreements that ease this integration of payment systems. So at the IDB, we are eager to work with regional central banks. No? And here, just like a marketing thing, we please make sure you are part of FUSE. No, we really believe in this program. Okay, thank you, Cecilia.
Thank you. Lorenzo, you very elegantly laid out the frictions, but you also talked about what is actually improving and pointed out the work of the G20 cross-border agenda, how regulatory issues, data messages, payment system operability, they all need to make progress. In addition to that, do you see sort of technical challenges that needs to be addressed, as well as the sort of more organizational ones, if I may call them that?
Yeah, well, more than technical challenges or technical opportunities, because also the new technologies, I think, help to solve previous technical problems. This trying to standardize, it was very difficult because we had to think of a standardization or technology integration for different payment system and thinking on the same technology or the same message for the whole process. And something that new technologies are helping is with this tokenization. Then we can have part of the process in this tokenized platform where there's interoperability, all the participants can enter in an established format, but it doesn't have to go all the way to the user, for example. No, so the principle, and just to put it in a very practical way, and using again the framework that is developing in Agora, what the principle is to have this tokenized money, which, by the way, I think it was also a very elegant way to go away from the discussion if it should be CBDC or not. And that was a legal issue for some countries. So instead of thinking on CBDC, well, think of just a tokenized form of money, but money is not the money itself. So we can, in technical terms and in terms of operations, might be the same thing, but in legal aspects, it might be much more easier to manage. But that's in the platform. So that helps to several things. One is that it allows to have only one settlement for all the participants. So we are talking about very difficult transactions because there might be the user, then there's the bank of the user, there's the correspondent bank, probably the central bank, then the other correspondent bank. So there might be different participants. So instead of thinking, well, why don't we get rid of all these participants and just have one thing, say, well, we don't have to change the way it operates. With the technology, we can have an atomic settlement, so all the participants settle at the same point, and it doesn't matter if we have 2, 1, or 4 participants. So that also helps to make all this organizational and arrangement out of the discussion. We don't have to discuss if we have to, this correspondent banking new model, we don't have to say, well, we don't want correspondent banking. Well, we want correspondent banking banks, but we can do it in a more efficient way. So the model and the way we operate very likely will change in the future. But what is important is to have a way to simplify the way we do things today without changing all, the most complicated things. So that, I think that technology, it's more like an enablement that is helping to solve a lot of these difficult issues.
Okay, thank you. Continuing to Governor Madrigal, you talked, and thank you for the rich presentation about the SINPE, or SINPE in Costa Rica. Taking it to the next level, what does it take to connect fast payment systems in different countries? What sort of main legal and governance obstacles do you see and advise to be addressed?
Some of the ones that already Lorenza mentioned. Coordination, there are legal issues, exchange rate, what will be the currency? How do we do internationally the settlement? Let me be clear with this. We have this fast system of payments in Costa Rica, and also we have these cross-border payments. But we don't have a fast payment cross-border system. What we don't have is how to take the advantage we have local in SINPE to take internationally. And we need a lot of coordination. For some of you that are familiar with Costa Rica, everything has to go mainly in the law. It will be a huge change, huge challenges. I think the people from the FLAR is helping us with that. There is this initiative, the FLAR, Latin American Reserves Administration group, that they are now going into this cross-border payments. And we are coordinating that. But yeah, the most, from my point of view, the most difficult task is the coordination. We have this thing with the Central American Dominican Republic. We want to set an international standard with the IBAN standard, and some countries didn't want that. So it was very difficult for us to change that. That is something international widely accepted, used to be like another Central American country or Dominican Republic. So it has to be more mature and to have this long vision that we want to integrate to the world to see what are the standards. For example, we didn't have any problem with the messaging system that we have. Now we are in a group with the OECD for this economy, more digital economy, and they are asking for this standard of accounts. Okay, so we will change to this ISO 20022. Something like these little steps that we need in order to have this standardization in many senses, in regulation, maybe in taxes, in how to deal with the exchange rate. And money laundering is another big friction in this, and we need to do that. We want to comply with that. So this is the kind of challenge that we have. Maybe are not as technological, but they are more institutional in the sense that the rules that we set in order to fix a conflict.
Thank you. Thank you very much. So, Governor Galípolo, your institution have impressed the rest of the world with PICs, but you also have the DREX project. So it would be interesting to hear you unpack a bit more what sort of merits you see in these more novel technologies, tokenized deposits, new versions of central bank settlement assets in achieving payments integration. Is it even possible that crypto can also play a role in this package of needs that needs to be satisfied?
I think that there are some particularities that we have in Brazil that deserve to be mentioned here and probably can establish some kind of links with the previous presentations that we saw here. First of all, I think Agustin made the question about why don't we use, if you are using stable coins, why don't we use public money digitalized or in some kind of crypto? We in Brazil saw a huge growth of the use of cryptocurrency or crypto assets during the last 2-3 years. And that lifted questions about the motivation, why we saw such a huge growth. At the beginning, we saw that more than 90% was stable coins. So the question was probably, we assumed that probably it was an easier way to have an account in dollars, for example. But then there was a discussion if the motivation was much more a speculative motivation, if they were buying to buy dollars for investments, or if it was a currency or to means of payment. And the answer was it's much more to use as a means of payment. And most of that to buy things and to shop things from abroad for cross-border payments. And usually things that people are buying, and that's the bad part, they are using that because it maintains some kind of opaque vision for taxation or for money laundering or things like that. This is not an accusation or something like that, but when you see what people are buying, and so we are already using crypto for cross-border payments as a mean of payment. But there is always this doubt if the motivation behind that use, it is one kind of derivation of the trust idea that Chris mentioned. It is a kind of privacy, but not often or not always a privacy because you don't want that government knowing what you are doing for other reasons, or the government is cross, but probably because people are buying things and they don't want to declare what they are buying because they want to avoid some kind of taxation or things like that. So this is one thing that worries a lot and puts a challenge for Brazil in surveillance and regulatory, because there are clear divisions between the privacy, the fiscal privacy and the financial privacy. And this exchange of information between the internal revenue and the central bank is not easy because we need to respect that idea of the privacy. So this is the first thing. The second thing is about the DREX, as you question. Since the beginning, and probably this is a bias, when I look at the DREX and what the DREX could solve as a problem, it always seems to me that the solution that first Carsten proposed it and now was presented here could be much more well fitted to the solutions that we want to address since the beginning, because DREX is not a central bank digital currency. It is a DLT with tokenization of deposits and assets with a structure of smart contracts. This is the idea of the DREX. And it's curious because in Brazil, the expectation that we have and the expectation that the population has with the DREX is to solve not only as to payments, but especially to create an infrastructure, a public infrastructure, that if you have the custody of the assets and the money, probably you could improve finance with collateralized assets. Because in Brazil, the participation of high-cost loans and credit is really high. And part of that is because of difficulty that you have to have guarantees and collateralized finance. So with the DREX, when we try to explain to people what kind of problem that the DREX will solve in your life, usually the example that we use is you can have collateralized finance and credit using this infrastructure. But then again, I think we need to think at the innovation, the technology as a mean, not as an end of itself, and looking in which problems we can solve. And I personally see the solutions that the BIS are discussing today as well fitted to the problems that we have today in Brazil.
Thank you. Okay, time to open the floor for questions. And Alexander, you were quickest, so you get it first.
Thank you so much. Great discussion. Perhaps question for the two governors in the panel. We do, as was mentioned here, integrating fast payment system. It's doable. There is technology for that. We do have projects, and I speak under your control, Cecilia. For instance, Nexus integrates fast digital payments in Asia, and so on. But of course, to integrate, you have to have the economic case, you have to have the critical mass for it to be worth it. But also, if you integrate the two systems here, you have the problem these currencies are not convertible. Mm-hmm. So you need a layer of liquidity, of something that is accepted by both jurisdictions. And here in the Western Hem, we do have the common currency, which is the US dollar. So how do you see, going forward, the potential for integration of payments in the region, and the issue that we do not have this convertible currency? Do you see this is a problem, or what's the vision?
Please.
Okay. Well, for us, the answer is we're a small open economy, highly dependent on trade. We use dollar as the currency for these international transactions. So our proposal maybe should be to use the US dollar as the settlement currency, but it has to be agreed with the others. This is the first challenge. Maybe it's an easy one. In practice, the whole world is accepting the US dollar as the main international currency for settlements, but it's one issue. It has to be agreed among the participants. This is the reason we need some instance for coordination. This will be my answer for now.
You know, there was a comedian in Brazil that used to say that technology was invented to solve problems that didn't exist before the technology. But in this case, it's the other way around, because this new technology already provided solutions to this kind of problem that you are raising. I think the challenge that we have are the old ones, as you mentioned, the convertibility of the currency, to create a critical mass in the way that Karsten mentioned before, creating more integration in trade, more financial integration. This is the old questions with a new kind of cloth, to use the picture that was used before here. So, and Brazil is trying to do it with new agreements with Europe, trying new agreements with Mexico, so that's the idea, to create a critical mass and try to overcome these old challenges that we have in our economy.
Any other question? Okay, the gentleman in the light blue tie, please. Maybe you should state your name.
Guillermo Avellan from the Central Bank of Ecuador. I have a question for Governor Madrigal. Instant cross-border payments have had a great success in Central America, as you show in your presentation. I'm wondering how difficult it was to connect different platforms managed by different central banks. I'm wondering if international bank accounts was required during this process, or you were able to implement later?
No. What I was talking about was how well the SIMPE works in Costa Rica for domestic payments with the Colón. There are other forms of cross-border payments. For example, there is a regional bank. Just as a short story, is a person working in Costa Rica that gets their payment every week. They deposit that in the bank. Actually, he asks the payer to put the money in their bank. Immediately, a person in Nicaragua, this I know for real, a person in Nicaragua will have access with a bank card to go to a ATM machine and take the dollars. That's something what was paid in colones in Costa Rica. No central bank in this transaction. This is for the regional bank. Also, we have the traditional SWIFT, but it takes sometimes days in order to do the clearance of the operation. And also there are other efforts. But the challenge is how to make these positive characteristics of the fast payment in SIMPE to take abroad. There is this development with I mentioned before, the Consejo Monetario Centroamericano, called CIPA. It has some traction, but not so much so far. It's, when you compare the volume and the quantity of transactions, it's very small in proportion for a country in Costa Rica that is, for example, it is exporting like $12 million a year, something like that. Imports maybe $13,000. So you have maybe a trade that accounts for more than 50% of the GDP in Costa Rica. So what CIPA is doing is very, very little. And also we have to do through this process of standardization. The fees is a big question. How much will be the fees? We in Costa Rica, we don't believe in telling to the intermediaries, you have to charge this. No, I can tell you how me as a central bank can charge you, and you can take the service or not. But the relation with the customer is between you and your customer, and the central bank has nothing to do with that. It allow the competition to solve that. So this is the kind of problem that we have. I don't know if he answered all the questions, but I will be more than happy.
Augustin, please.
I have a question for Lorenza, but obviously others can jump in. I mean, I have the sense that the traditional institutions that have been in the banking, but also in the payment space, we are too attached to our forms of doing business. And it is my sense that, I mean, the banks in particular have a very important platform to modernize everything and make it everything very effective. But I see that it is very difficult for them to move fast. So do you think that the legacy systems is an issue? Do you think that regulation is an issue? Do you think, how afraid are the commercial banks of what's going on with stablecoins, for example? And so what is the type of response, or how can I mean, obviously at the end of the day, this should be open for all participants, no? But then there might be circumstances where authorities are holding back the change, but there also might be situations where the banks could do things in a different way and sort of do leapfrogging and become more efficient. So how do you see this? I mean, it's not a very clear question, but for me to understand better how that interaction takes place is very important.
Yeah, I think that when I was at the central bank, I was always thinking on that. Why is that it takes so much for the banks to adopt something new, and why is that? Definitely, the legacy, the technology, is a big issue, and I have seen that since I was at Accenture as a consultant, and I saw different banks. And in the two banks that I have been working, I see that changes in technology are very difficult to do, and especially because you have to be doing a lot of things at the same time. So you want to update a system that is already too old and that it doesn't work with new technology. Then you have to also include new products because you have to go with the competition. There are some risks that you also have either because of regulation or because you had identified in terms of fraud, in terms of cybersecurity, and then you have to solve those. So there are so many things going in terms of technology that it's becoming, I think, one of the most difficult things in banks, even if they are not very big banks, but the systems that we have, that they are still not as people say in technology, no, this is blocks, and so you can change one block and then another. At the end, it doesn't work that way. You have to be moving that. So I think that's one issue. The other is that the way the competition is also a big point. I'm not sure that stablecoin is the most, the closest competition that traditional banks see. Probably it's all a different type of fintechs. And going into what I was mentioning before, that fintechs can go to satisfy the need for a specific user. So these very general solutions don't work anymore. So you have to have a service for small firms, another for big firms, another for retail. So this, the way that you have to provide different services to your different customers is difficult, and you can be losing some of these segments because of the competition that is targeting specific segments. And in regulation, yeah, it's difficult regulation, but I will say, and probably some of my colleagues won't like this, but, and my background also might affect this, but a lot of regulation are things that we want to do in any case. For example, for AML, there's huge regulation for AML, but we don't want to be involved in any AML issue. Even it doesn't matter if there's a regulation or it's not a regulation. Sometimes we go beyond regulation because it's a risk that we see. So some of the regulations are difficult, but are targeting risks that we need to also be managing. Mm-hmm.
Please.
In answer to Agustin, yeah, it's all that you said, I saw in my country. I saw, for example, the traditional banking entities opposing for the registration of the fintech. It's this thing. Sometimes it's we ask, why do you do that? It's the way that we do things. No, but you can do more efficient. I can put an example. For example, making transactions with a foreign exchange. They have this standard of T+2 to settlement. Why? There is no need. We can do real time. And it costs a lot for them to get in T+0, yeah, and T. Things like that. So there is a combination of many things. Fear of competition, it's expensive to do technological changes, and also this legacy thing or traditional way that we think. And ignorance from our side as regulators too.
About the issues around stablecoin. We heard Professor Christine Parlor earlier. Her forecast is, if it happens, is going to be a big wake-up call, I think, for the community. On the other hand, it was reassuring to hear Lorenza saying that it might be more of the fintech and more tailor-made needs that needs to be satisfied. And those who are like me thinking that the fiat money system is still the best system with central bank money at the core. Hope you're right, but we'll live to see. Please join me in the hand for an excellent panel.
Thank you for the excellent panel. Now we will break for lunch. So it is time. Please join us in room D. That is just where we have dinner last night. At the back of your badge, you will see the name of your table in case you are wondering where to sit. And we will reconvene here at 2:15 for session 5. Thank you very much. Hello, everyone. I hope you have enjoyed your lunch. Thank you. Now it is my pleasure to introduce Agustin Carstens, who is the General Manager of the BIS, and who will be delivering the keynote speech, Lessons Learned and Challenges Ahead for Central Banks in the Americas. Please join me, welcome me, Agustin.
Well, again, welcome all of you to this Chapultepec conference. And let me start by acknowledging the very hard work of Alexandre and Tana, and together with all the team here in the BIS, in the representative office, and also my colleagues in Basel that have supported this effort, including Tao came from Hong Kong. So we are very pleased about it. So today's conference has a very rich agenda. We started the morning by discussing global financial conditions and digital innovations. And after lunch, we will turn to monetary policy. I will use my time today precisely to give some background to this afternoon's discussions. I will aim to provide some perspective on the course of monetary policy in the Americas over the past few years. I will then turn to what I see as the key challenges facing central banks in the region in the coming years. My comments will focus on Latin America, although many of the themes have broader relevance. Monetary policy developments in recent years have been profoundly shaped by the events of the COVID-19 pandemic and its immediate aftermath. When the COVID-19 pandemic struck in 2020, central banks throughout the world took decisive measures. They lowered interest rates to record lows, offered new liquidity facilities, and expanded existing ones. Many central banks also made asset purchases. For advanced economy central banks, including the Federal Reserve and the Bank of Canada, the policy response followed a broadly familiar playbook, although the size of the response was unusually large. But for many emerging market economy central banks, including those in Latin America, such a strong counter-cyclical policy response marked a departure. In past crises, policy had often responded procyclically, not least due to concerns about possible currency depreciation. Two factors contributed to this different response in Latin America during the pandemic. First, monetary policy frameworks in Latin America had been strengthened over the previous decades. In particular, the autonomy obtained in the 90s was a rock-solid foundation, without which counter-cyclical policy response would not have been possible. Second, the COVID-19 pandemic was a global shock. The fact that central banks worldwide, including the Federal Reserve, were loosening their policy stances no doubt made it easier for central banks in Latin America to follow through. While the policy easing at the start of the pandemic was highly synchronous, the tightening in its aftermath was less so. Latin America in particular were relatively quick to unwind emergency policy settings in response to emerging inflationary pressures in early 2021. In doing so, they drew on the experiences of the 70s and 80s, when high inflation and wage price spirals were prevalent. Monetary policy in advanced economies was, in my view, more heavily influenced by the extended period of below target inflation that preceded the pandemic. Early and forceful policy tightening worked. By slowing demand, it contributed directly to lowering inflation. Just as importantly, decisive tightening helped keep long-term inflation expectations anchored. Even when inflation initially rose, the public never lost confidence in central banks' commitment and ability to bring inflation back to target. In countries with a history of high and volatile inflation, like many in Latin America, this is a clear success. It has helped to prevent a wage price spiral similar to that experienced during previous episodes. Moreover, unlike in many episodes in the 80s and 90s, there was no financial or banking crisis. The job is not done, however. In much of the Americas, inflation remains above target, and the road back to price stability looks bumpier than it did even 6 months ago, not least due to the heightened policy uncertainty. Over the past few years, central banks were able to draw on their accumulated credibility to limit the rise in inflation and bring it down at relatively little cost to economic activity. But to safeguard their credibility for the future, they have to see the job through and deliver on their mandates. Let me spend the rest of my speech discussing some of the challenges that I believe will affect the conduct of monetary policy in the coming years. The first challenge is policy uncertainty. Trade policy is the most prominent example, but the future evolution of fiscal policy, regulation, and immigration policy is also open to many questions at present. Moreover, the geopolitical backdrop remains in flux. Such pervasive policy uncertainty will affect central banks in several ways. Uncertainty itself is likely to weigh on growth. Firms will postpone investment. Households may avoid large purchases. In isolation, these effects would weigh on inflation. But an uncertain world is also likely to be a more volatile one, particularly for financial markets. Already in recent weeks, we have seen sizable swings in asset prices, including exchange rates, as market participants struggle to determine how policy settings would evolve and how to position themselves accordingly. Some of these asset price movements, particularly exchange rate depreciations, could be inflationary. At some point, of course, many of today's policy uncertainties are likely to be resolved. Depending on the policies adopted, these choices will have their own consequences for growth and inflation. The second challenge is high public debt, and in some countries, unsustainable fiscal positions. Public debt was already high in much of the world before the COVID-19 pandemic. It has increased further since then, and the widening of budget deficits at the start of the pandemic has still not been fully unwinded. Loose fiscal policy complicates the task of central banks in several well-known ways. By contributing to aggregate demand, it adds to inflationary pressures, complicating the return to price stability. By raising doubts about the long-term sustainability of public finances, it can increase interest rate risk premia and can lead to currency depreciation, further rising inflation while weighing on growth. In the extreme, an abrupt repricing of public debt could put financial stability at risk, especially in countries where bank and non-bank financial institutions hold large shares of the public debt. But even if these channels are familiar, central banks will still need to navigate the consequences. The third challenge is international divergence. As I mentioned before, the COVID pandemic was a global shock, leading almost all central banks to ease policy at about the same time. The subsequent inflationary outbreak saw most tighten policy, even if many emerging market economy central banks started to do so ahead of their advanced economy peers. Going forward, economic conditions and hence appropriate policy settings are likely to be less synchronous. In particular, economic growth in the United States has been much stronger than in much of the rest of the world of late. Should this continue, we could see greater variability in policy settings with flow-on effects to capital flows, exchange rates, and global financial conditions. A fourth and related challenge is continued sluggish productivity growth in most countries in the Americas, except the US. Some factors behind this problem are insufficient investment in infrastructure, education, and technology. Many countries face structural inefficiencies, such as rigid labor markets and bureaucratic hurdles, which hinder the ability of businesses to innovate and expand. A retreat from globalization and widening trade fragmentation could weigh on productivity growth further. Low productivity growth makes central banks' life much harder. In particular, it creates pressure to keep policy settings loose in order to sustain economic growth in the face of weak fundamentals. I don't need to tell this audience that this policy prescription is all wrong. Addressing low productivity growth requires structural reforms that make it easier to open a business, compete, and invest. Regrettably, structural reforms had been lagging in many economies well before the pandemic. Consolidating fiscal positions and rationalizing public expenditure may also free up resources to improve public investment to develop necessary infrastructure and improve human capital. Such policies, of course, lie outside central banks' toolkit. Faced with all of these challenges, many of which are beyond their control, what can central banks do? A first task is to ensure that at least one key prerequisite for sustained economic growth, price stability, is beyond question. In doing so, they can help remove one potentially destabilizing source of policy uncertainty. The history of this region features, regrettably, many examples of the adverse consequences when the public loses confidence in the ability and willingness of central banks to achieve their mandates. The experience of the COVID-19 pandemic showed us how much better outcomes can be if such confidence is maintained. That said, the specific policy settings to deliver monetary and financial stability are themselves uncertain. Much will depend upon how uncertainty evolves and on the specific constellation of policies that are ultimately adopted. Appropriate policy settings will also change over time. In the meantime, bouts of market volatility are likely. At such times, central banks may need to act in a judicious and limited manner to safeguard market stability. So central banks will need to remain on their toes, be attuned to recent developments, and stand ready to act firmly and decisively when required. While central banks' ultimate objectives, monetary and financial stability, should be steadfast, commitment to specific policy settings should be avoided. Maintaining flexibility to adjust policy settings rapidly in response to changing circumstances will be at a premium. Beyond the immediate conjuncture, I believe the time is also opportune for central banks to build on the lessons of the past few years in order to better prepare themselves for the future. The policy reviews currently being undertaken in a number of economies represent such an opportunity. In particular, a key lesson that I draw is how quickly and fundamentally seemingly pervasive features of the economic landscape can change. Before the COVID-19 pandemic, there was broad-based agreement that the global economy would face strong deflationary pressures for the foreseeable future. Real rates were expected to remain at historic lows, raising the risk of persistently liquidity traps. Today it is clear that inflation risks are much more two-sided than we had previously thought. And it is also clear that the general public is much more resentful of even a relatively brief period of high inflation than a prolonged period of modestly below target inflation. Our policy frameworks should take these lessons into account, but they will also need to be robust to a future that could look very different from even the immediate past. A key reason for the success of many Latin American central banks in navigating the post-pandemic inflation surge was their ability to adapt rapidly in the face of changing circumstances. Such adaptability is a trait to which all policy frameworks we should aspire. Let me close with a plea for central bank cooperation. Central banking is not a zero-sum game. Inflation above target or low growth in one country does not benefit others, but instead makes their life more difficult. This means there is a significant scope for cooperation. It will be much easier to meet the challenges of tomorrow together than alone. The BIS will be there to support you in this endeavor. The BIS mission is to support central banks' pursuit of monetary and financial stability through international cooperation and to act as a bank for central banks. The BIS Americas office will continue to promote cooperation among central banks in the Americas and the Caribbean, as well as linking central banks in the region to those in other regions. Thank you very much.
by our General Manager. Welcome to our fifth session. Continuing with our topic of technological innovation and digital change, we will be discussing challenges for the central banks in the digital era. Navigating the digital era presents unique challenges, but also opportunities for central banks, and this session will shed light on these critical issues. Our moderator for this session is Hyun Song Shin. Please join me in welcoming Hyun and Governor José Luis Escrivá from Banco de España.
Well, welcome back, everyone. It's been a very rich day's worth of discussions, and I think that we will have also an equally good afternoon's discussion. This morning we talked about payments, tokenization, and interconnections. We're going to stay on the technology theme for this session, but take it one level higher, to a level where we can sort of discuss the challenges much more broadly, including AI. Now, I can't think of anyone who is better at discussing this issue than Governor José Luis Escrivá from the Bank of Spain. José Luis and I first met when I started at the BIS, and we overlapped for a very short period. So I was coming in, and he was going out, and he was the chief representative here in the Americas office of the BIS. He went on to become the fiscal watchdog in Spain, and then he served very many roles in the government. Most recently, he was the minister for digital transformation. And I remember this very, very engaging discussion that I had with him on AI and challenges for the official sector, actually, in the age of AI. So it's not only computing power, although I'd love to hear how DeepSeek is going to affect the need for compute in this setting. But it's much broader than that. It's the access to the trained workforce, huge HR challenges in having the right set of skills for official sector institutions, especially central banks, to navigate the challenges. But also issues to do with cloud infrastructure, concentration, but also security, and concentration and competition as well. So on all of these issues, I think, José Luis, you're the perfect speaker. So without further ado, let me give you the floor. And José Luis will prefer to stand up and use the podium. So let's give him a big round of applause.
Thank you very much. Or do I? Yes? Yeah? Okay. Thank you very much, Hugh, for your words, and thank you very much to the BIS, to Agustin, to Alexander for his kind invitation to this conference, which has a name which is, as you said, is very close to my past at the BIS. I was requested to focus in this presentation on the challenges of this new digital transformation, revolution to central banking, but also building on my previous job and trying to combine my view now of the state of the art on these issues in central banking after a few months coming back to the central banking community, but from the perspective of what I have learned over the last years. In doing so, let me start out with the general remark on this technological change. To me, I mean, we have to see it as a continuous of innovations back 30 years with Internet, but after Internet, we have had a number of important changes and innovations, both on hardware and on software, big data, connectivity, machine learning, in semiconductors, in speed computing, cloud technologies, etc. And for years, economists we have been struggling with the fact that all these innovation and technologies in isolation were not producing big productivity gains. Actually, even some years ago, Robert Gordon drafted an entire book to conclude that we should not expect too much from these technologies. I think now, at least me, but I think growing many people are concluding just the opposite. And I think the reason is because all these innovations have been ingredients that putting together and connected, and in particular with the arrival of deep learning and AI technologies, produces something which is extremely widespread and impactful. In a way, deep learning should be seen as a sort of ice on the cake from all these other elements that are necessary conditions to produce this very transformational technology. That's the way I see it. So my view is that in the years to come, and we can even already witness that the countries that have been more rapid in absorbing this innovation and diffusing the entire economy are already reaping benefits in terms of stronger growth. But to me, this is going to be, because of the nature of this technology, expanding rapidly to the entire global economy. Sooner or later, it will be there are first movers, but there are also followers that will benefit with lags. So that's the way I see it. From that perspective, I have tried to go through the various functions of the central banks or the central banking in general, and to see what we stand with this technological change. And this is what I try to represent in this slide. Starting off with financial stability or macroprudential, and here I'm not going to elaborate too much because particularly since probably here we are well advanced. Since in particular of the financial crisis, central banks, we are very fast in spotting risk, in identifying risks and trying to evaluate them. So here the risks, as far as I see it, in the work has been done, are already identified and already examined, and it's a matter of monitoring them. So I will not delve too much deeper into this. Let's move to microprudential, both from the perspective of solvency in general, but also from the conduct and consumer protection. And here I think the situation is more of catching up. Certainly we need to encourage banks to engage in digital instruments, in new technologies, but at the same time we need to understand well how they work in the banking operations. We need really to have internally the expertise to introduce this in our supervisory activities, but also from the conduct perspective, we need to know whether these technologies are misused sometimes. And also, I think privacy of information and data is also something we need also to factor in the way we operate with banks. And then it comes, in addition to a number of technologies, artificial intelligence. And this adds within a further challenge that is going to become very pressing in the years to come. To me, most central bank and supervisors will have to engage in supervising or having to say something about the models the banks use on AI models. Here, those models that are what we could call high-risk models in the sense that they make decisions based on deep of AI, generative AI technologies on ranking individuals, creating scorings, need to be carefully examined because this is serious stuff from even human rights perspectives. But in more general sense, we really don't know. Banks are probably, as many other sectors in the economy, are going to intensively use these instruments in the years to come, and we still don't know exactly how they are going to work. So what we need to do internally in our banks, in the central banks or supervisory bodies, is to have a good repository of events, of possible problems, and trying to learn from these problems and from this experience how things are evolving and trying to monitor them, and maybe at a certain point in time to need to act or to introduce in the way we interact with the bank we supervise in a way or another. On payments and financial operations, I think there was a previous section. I'm going to basically skip it because, of course, there are many elements here that have to do primarily with technology in a way or another, but you already have learned a lot about this and already know a lot about this, so I don't need to go further on this. On monetary policy, I would say, okay, in payments, I want to skip it again. I will focus on monetary policy. I mean, if you really believe, as I do it, that this AI revolution or more general and related technologies is going very, very impactful on the economy in different ways, still uncertainty about the timing and the scope, but certainly very impactful. No doubt this is going to affect, I mean, the economy, the state of the economy, the transmission mechanism, the effectiveness in which we conduct operations, and we really need to monitor this and trying to introduce in our models. It's not easy, but I think it's something that sometimes we do it in a too ad hoc manner as energy and other elements which are also very important, but I think that's something that will require a lot of work, a lot of research. We have already a number of pieces, but this is going to be an avenue of further research for the years to come, no doubt, very intensively in our research communities. I mean, if you believe, as I do, that this is going to be really growth enhancing and productivity gains will be very substantive, because this is a general, important, it's a general purpose technology. It may affect so many sectors and even science, general research in many directions. The evidence that I monitor in the sense that since I was working previously to this job, I continue reading about this, and I realized that I'm increasingly convinced that this is going to be genuinely a very general purpose evolution with a lot of ramifications here and there. And if this is the case, I mean, this is going to impact potential growth, employment, also in a less clear manner, but certainly potential growth should increase. We need to try to grasp this, and in doing so, my sense, and this is, sometimes we tend to work, economists in the central banking, very on our own on this issue, which is very technical. We need to work in a multidisciplinary manner with engineers, with technologists of different kinds, and to work together with them, because it's not just passing a few filters or using models that we use it. We need really to work closely with people with specific expertise in this area if we really want to grasp all the complexity of what we are witnessing. GDP and inflation forecasting in general. My sense is, and this is still, I mean, and Hume has written even about this, and I think I agree with him, the neural models that are underlying deep learning are able to capture connections, non-linearities, in ways that we have been able to do it with the toolbox that we have been using, the statistical modeling. Certainly, we have an explicability challenge here because it's not easy, or I mean, it's impossible by nature, but certainly there are patterns that we haven't overlooked that can be captured by combining the information that these models can process together with the way the models are solved in terms with neural models. I mean, this is very challenging and sometimes even very exciting, because it's certainly something it's a very different animal from what we had been learning and working for years as economists. And finally, on communication test and sentiment analysis, this is also probably this is a long-hanging fruit. And since it's a long-hanging fruit, I just give you an example for something. It's very, very tiny, it's very anecdotal if you wish, But it had been done at the Bank of Spain very recently using the large language model and with an application that it has been used in order just to show, basically using a broad analysis, I mean, in the European, in the Eurosystem community, how views of governors are distributed according to the views about monetary policy. Compared to, this has been done before by others, but when I went through it, I realized that this is probably more sophisticated and more accurate than what has been done before, and certainly uses techniques, which is deep learning techniques, which are interesting. Just for you to know. So what we are and in which direction we should go in the central bank. And I would say that first, primarily the intent of AI, what we are using, to my knowledge, is use cases. And we are starting to generate governance internally and approaches, but we are not in earnest using intensively AI. That's the reason in this slide, the label I use is the challenge is scaling up. Moving from just these examples, these use cases, to a systematic use of AI techniques internally. And this is a challenge for us and for many firms as well. So we need to be aware of it. At the same time, we are doing innovation center, that's fair enough, but still the next step is just to use it really in the day-to-day work. And that's really something we should not forget. That is very challenging, but I think it might be very productive if we are able to arrive at that point. And in terms of supervision, I think that at a certain point in time, we will be given responsibilities. In Europe, it's already the case for the supervision of the models. Banks are also going slowly with this, in part because of the fragmentation of the regulatory framework. But we need to be in tandem with them over time. And for this, we need to be prepared to be able to integrate in our supervisory frameworks, and that's something that still has not been done. For that, we need staff, skilled staff. As I said before, engineers and software developers. That's not easy because it's very scarce human capital at present. There are shortages in the world, and we are not probably the most attractive firms for them or institutions, but we need them. I mean, and I think, of course, we can outsource a number of things, but it's important that we internally also introduce in our staff people with complementary profiles. Computation capabilities. I think it's true that we are, in a way or another, relying on external, on cloud facilities and whatever, but we need, for a number of reasons, I mean, it will take time to spell it out, but I think we need to also internally to invest on our capacity for computing and supercomputing and modeling. On data, we need to work with our data sets. We need unstructured data, which is one of the ingredients of that, work in terms of what we call corpuses, which is something not exactly data as such. We need curators of data, which is a new profession that will become also relevant to us. And for that, I think we need to pool resources. This is really very complex and very complex and very demanding in a number of directions. I mean, I think no central bank in the world can do it in isolation. We need to work together. The BIS is certainly a place to work together in a number of directions with the Innovation Hub and other initiatives, because I think it's a matter of sharing resources, pooling in them, and trying to learn to advance together in a number of directions. This is why collaboration, but we also need to collaborate with the external world, to the central banking. And here I think that public institutions, private, the big hyperscaler also, of course, are always available to us. So there is we need a mixture of internal enhancing of capacities with external support, both, let's say, more on the research or academic area, but also in the private sector. But we need to do it all together. And we have a number of dilemmas which are not easy to solve. I mentioned just here a few of them on cybersecurity. Certainly, central banks are risk averse, so we need to enhance very much our resilience here, and certainly the case, but here there is always a trade-off. At a certain point, if we go too far, I mean, we may limit the usability of certain elements and capacities, so a good balance here I think is important. On cloud computing, I would say, I mean, the easiest way is to go to a public cloud. They are just only a few in the world, so it's not something the competition is limited, but they are very good ones, and they provide very good services. But to me, and that's the way at least we are approaching this in my bank, we need to do it to a limiting the number of information that I think should be kept local. And the solution here is going for hybrid cloud, hybrid technologies, which are available, but we need to build it carefully internally in our banks. And also, I think, as I said before, since there are only a few providers of a few things, there is a risk here of concentration, and that's something we need to be aware of for us and for our banks, and I think this is important. What I already said, hybrid clouds, strategic alliances with the private sector, I think we are just signing MOUs, 5 minutes, I capture it, no problem. I mean, the second challenge, I think I'm going to skip it, is about regulatory fragmentation, if someone wants to, I mean, just for the records, because I want to go to the end. Second, another challenge we think is spreading innovation, and I think this is key. I think that we really, I mean, those who will be able to diffuse these technologies more rapidly, also even in the central banking community, I mean, we'll reap the benefits earlier, and I think this is something we need a sense of awareness about that, and this is what it's about, this slide that I just skip it. But there are challenges. I mentioned just green transition. I mean, there is a sense of awareness here, but at the same time, it's true that it is mentioned that these technologies are very energy intensive in a way or another, also water intensive sometimes, particularly data centers. I would say that I am here less concerned than the average. And the reason for that is because I believe this, I know that because this is the case, but at the same time, there is a lot of research and innovation in this area, already producing positive results, that because it's so costly from an energy standpoint, there are going to be soon a new wave of technologies in semiconductors, for instance, that are going to be able to, and modeling, that are going to be much efficient in terms of energy. But this is a challenge. I mean, that is mentioned, and I wanted to just reflect it here. I think that on digital payments, I believe that we need to move very rapidly and to use whatever techniques, because this is a way, and this is very much important in the region, in Latin America, where I think that we need to really, a key element is to reduce the number, the size of the informal economy, and the digital tools are very important in this regard. And just to conclude, I just want to conclude to the way we see it at least in the Bank of Spain. We have identified like 3 T's in the way we feel we need to approach these challenges. We need to invest more on technology, the first T. I think that this is worthwhile. I mean, upfronting investments in supercomputing, in cloud, in hybrid cloud, this kind of thing. Also in software, but software is cheaper. I mean, the hardware is the most expensive thing. We need to invest on human capital, on talent. We need to be very aggressive, with quotation marks, in trying to capture people with profiles that are not non-existent or very rare in central banking, technologists, engineers, that really can help us in a number of directions, and combining these with people we have already in our central banking functions. And we need it, and this 30 to me is very important. We need a transformation from an organizational and cultural point of view in order for us in our central banking to be able to absorb and diffuse these technologies through all the functions that we perform that differ across central banks. So we need the three things at the same time. And I think we are able to do it in parallel, and it's not easy because there are a scarcity of these things and the starting point sometimes is not as good as it should be. If we are managed to work on these three T's, I think the central banking is going to be more efficient, we are going to perform our functions better, and we're able to interact with the banks, with our clients, with quotation banks, much better. Thank you very much.
Well, thank you very much. Thank you very much, Jose Luis, for giving us a lot of food for thought. And this is a very wide-ranging presentation. And so my colleagues are sort of showing me a sign that we should, we should really have a sort of a much more focused discussion, perhaps, given the time. But I did want to just highlight your three T's, I think, which are very, very important. So the technology clearly is very important, the talent, as well as the culture, the transformation. On the talent, and I'd be very keen to get your views on this. On the one hand, clearly the real experts in this field, in particular in AI, they are very much sought after by the private sector. But on the other hand, central banks really value technical expertise. I mean, it's an institution that has a very important public purpose, and so I think there are people who would be very highly motivated by that. And the culture, with a lot of economics being done in the building, is a close cousin to neural networks, all the machine learning techniques that people have. And so I guess central banks, among other public sector institutions, might be better placed. So I'd be very curious to hear more about that. And on data, I think you made some very, very important points. And as the minister for digital transformation, I think you had much more experience than pretty much anyone in the room actually on this. I guess we have to shy away from the temptation to think that somehow the techniques themselves will give you great results, and it's the data that really gives you that.
Absolutely.
Yeah. So if I may just ask you to just reflect on, if you like, 2 or 3 key points to share, that would be great.
Okay, there are very important questions, all of them, and challenges in a way. I would say on the capture of talent for us, from something which is scarce, it's true. I think that there is an angle, and I also experienced this in the public sector, because there are quite a number of technologists and engineers that value very much that the public goods involved in what they do. So even there have been people that have moved and renounced to much higher remuneration or because they feel that what they are doing is not sufficiently relevant for the society as a whole. I mean, and if we are able to convince these kind of people that what we do is very important for the society as a whole, I mean, keep financial stability, keeping inflation low, all what we do is certainly implies private goods, very, very high level public goods. I think if we with this narrative, but we need to be active, I think there are good chances that we can attract very good people in this area. This is on talent. My experience is that way. On data, certainly. I mean, on this area, supercomputing is certainly a potential bottleneck. Talent is another one, but what is going to be more scarce and more valued, and I think there is a growing consensus about that, is good data, curated data, and also combining different sets of information, because by combining them and using these techniques is what you can really get something differential. And in this regard, I think we need also to enhance a culture of sharing information, also in central banking, among central bankers in the world, sharing information, putting together different sets and that's something that there is resistance of sharing, because cooperations, the DNA for cooperation sometimes is also scarce. So we need really, but here cooperation is key, and putting together, and the data lakes need to be very well structured, need to be, confidentiality is important, but I think we need to deal with it in a way in which we can able to fully exploit information. I mean, for me, this is key, and this might become also differential if we are able to achieve it.
Excellent. So I see a 0 being held up. So we could go on for a long time, but I think we'll close it there. Thank you again, Jose Luis, for sharing your results.
So welcome to our 6th session. We are now returning to our initial topic of uncertainty. One of the strongest realization of uncertainty in recent time has been the COVID-19 crisis. So this session is titled Monetary Policy in Latin America, Lessons from the Pandemic. We'll highlight the importance of understanding how monetary policy expanded its toolkit to navigate the crisis and mitigate a more severe economic slowdown. Our moderator of this session is Governor Julio Velarde from the Central Reserve Bank of Peru. Julio Velarde has been the governor of the Central Reserve Bank of Peru since 2006. Previously, he has conducted consultancy work for entities such as the IDB, the World Bank, the International Development Agencies, and many others. He has a long story of consultancy. Please join me in welcoming Governor Velarde and our speaker, former governor of Bank of Chile, José de Gregorio, Pepo for the friends, who will be presenting his paper on this important subject. Please, Governor Velarde, the floor is yours.
Thank you very much. Thank you for the opportunity to moderate this session. The title is Monetary Policy in Latin America, Lessons from the Pandemic. And actually, if we see the 90s, it was almost impossible to think of a Latin American country that could apply counter-cyclical monetary policies. Just in this century, we started. And although many countries, for idiosyncratic factors, have had their own counter-cyclical policies, the two periods where almost all the central banks were very aggressive were during the global financial crisis and COVID. During the global financial crisis, the situation was a little bit different. Inflation was pretty high. Interest rate was pretty high. Inflation in Chile was 9.9. In our case, almost 7. And interest rates were pretty high. So actually, the reduction of interest rate, of course, was much higher than COVID. During COVID, we had an inflation of 2%, interest rate of 2.25, so the decrease, we were aggressive, we went almost to 0. But of course, the reduction compared to the previous global financial crisis was much less. But well, Jose has been governor with me between 2007 and 2011 at the Central Bank of Chile. We faced the global financial crisis together. He invited many of the governors. One of them is here, Jose Uribe, former governor of the Bank of Colombia, to discuss what will happen in the global financial crisis. And at that time, different from COVID, there was more uncertainty about the magnitude of the effects. Many people were thinking it was being something close to a Great Depression. And the message there was inject liquidity, liquidity, liquidity. Now with COVID, we more or less expected what could happen. The uncertainty was how long it will last. Of course, we expect 3 months, 9 months, no fiscal monetary policy could have helped us to avoid a catastrophe. And we deploy a lot of weapons that are going to be explained, I suppose, by Jose. Jose not only has been a governor for 4 years at the Central Bank of Chile, previously he was Minister of Economics, and he has also a very distinguished academic career. He's actually a dean of the Faculty of Economics at the University of Chile. He has published a lot of articles, papers, books, etc. He holds a PhD from MIT. And Jose, the floor is yours.
Thank you very much. I'll stand up here. It's better because when you get nervous, you move your feet and nobody realizes that you're moving them. So thanks very much for the invitation. It's a pleasure to be here, to see again many central banks friends. When you are a central banker, you are a central banker forever. So I think that is a great opportunity. Now, in my case also, I've talked about old-fashioned issues. I won't talk about digital tokens and all of that. I'll go to the basics, which is perhaps are not the same basics as 50 years ago, but I talk about the COVID, what have we learned, and I'll go this is basically, I talk something about the policies during the COVID crisis, and then 2 additional topics that I think that are quite important today. One is what's going on with inflation and monetary policy today, and in particular in the region that has done, I think, extremely well, and some other macro policy topics that are quite important, and is the financial opening, all the discussion of vulnerability and some of macroprudential. But let me start talking about COVID. And as Julio said, when you talk about COVID, look at the watch. I always look at the watch as I will take care, but I don't take care. But it's a credibility device. So the COVID crisis. During the COVID crisis, I think that the origins were during the global financial crisis. That was the first time that emerging markets and Latin America, there was contracyclical fiscal policy, contracyclical monetary policy, and the economies performed extremely well. The last crisis in emerging market was the Asian crisis, and the Asian crisis was devastating for Latin American economies and previously the 1980s, but were devastating compared with what's happening during the global financial crisis. There we can see a bunch of countries during COVID and during the global financial crisis. Obviously, COVID was worse because we were without or working partially for many, many months, but performance was extremely well. And economies, what we see 1-2 years after the bottom of the crisis, they have already recovered. And this is to a large extent due to the policies that were implemented. And during the COVID crisis, expansionary monetary fiscal policy with a strong financial system. All the crises happened, and the deep crisis was in advanced economies, but there was no, except the usual countries with problems, but there was no systemic crisis in emerging markets. And that's because from the financial point of view, there was sound regulation, and from the macro point of view, monetary policy that implemented inflation target, and I think that quite central, a flexible exchange rate with some realism and sometimes with some interventions, but overall there was a flexible exchange rate. Now the COVID crisis brought something that was new, and the COVID crisis was, from the point of view of the economy, was a credit crisis. What's happened is that income for companies, for everybody, stopped because there was nobody working, and you have to pay your obligations, and if you don't pay them, you go bankruptcy, you have problems, and the financial system, whatever. So what central banks did all around the world, and governments, was to extend credit, and relatively cheap credit. So this should move, but it should move if I press this. So this is a loans to the private sector. So we see in emerging market economies, starting 2020, they went up during a year more than 10%, and there was a small increase in advanced economies. This is quite unusual, because this is the only crisis where I have found that credit goes up. The normal thing is that in crisis, there is a decline in the demand for credit, whether it's endogenous and what's causing the crisis, there is a decline in the demand for credit. All that was needed here was credit. And here we can see, comparing for emerging markets, what's happened with growth with respect to previous trend. would happen with the rate of growth during COVID and during the global financial crisis. We see that during the global financial crisis, there was a, despite the recovery and all the good performance, there was a decline, normal decline in credit. During the COVID crisis, there was an increase in credit. So I think that. And the rest of the story is well known. Basically, the policy response to the pandemic, there was a monetary loosening in the advanced economies. And as Julio said, in emerging markets, were rates relatively low. So the decline in interest rate in advanced economies went to zero very quick. So that's no wonder that they use a lot of a non-conventional monetary policy, expansion of central bank balance sheet. And in emerging markets also happened and was part of the expansion of credit, but not at the same level because there was a sharper decline in monetary policy rates. This is, although this is, I want just to compare with how was the performance during both crises. During the global financial crisis, the cut in interest rate were much larger, to some extent because we were starting from much higher interest rate. There is a big issue where we were getting closer now to the neutral. But during COVID, there was a reasonable decline in interest rate, but not as big as in the global financial crisis. The turmoil during the global financial crisis, and this is also interesting, I think that also is part of what markets assess about the strength of the economies. The turmoil during the global financial crisis, we see the increase in CDS, in LATAM countries, in all emerging markets, and we see a very sharp increase in spreads. This was a very bad assessment of what's going on with emerging market economies during the global financial crisis, but they very quickly normalize. They stay a little bit higher because of tight financial conditions around the world, but there was a rapid decline. What we saw in COVID, that is then there is this is again not emerging market, then there was a European crisis, Greece and all of that mess, you remember? And this was also tightened financial conditions all around the world. And during COVID, we see that there was an increase in risk premium, but was very limited. And this is to a large extent what was the behavior and the strength of the economies at the moment of COVID. So overall, I think, with this, I want to close the look at the COVID crisis. I think that is at the core of all what's going on, and perhaps I tend to overestimate, is the role of exchange rate flexibility. I think that this is, if we would have looked and we would have shown you this figure 30, 40 years ago to some economists from Latin America and said, this will be the fluctuations on currencies in emerging market economies in Latin America, they would say it's impossible. All firms will go bankruptcy. The governments that are highly indebted in dollars won't be able to pay, and there will be a collapse. So what we see in the left-hand side, starting 1 year before the global financial crisis, sharp depreciation. I have added also some, with the dotted line, some Asian countries, because they also went through similar patterns, not exactly the same, as also always Peru is the only very stable country. I still don't understand why, but it's very stable. It's Velarde, but it's exchange rate. But there was a sharp appreciation. Then comes Europe, and where the depreciation were not that large, despite the very strong dollar and the price of the dollar. But there was a depreciation more limited, no crisis in most emerging market economies, and I think that this has been key to navigate relatively safe during the turmoil without spillovers from forex markets to the real economy or to the financial system. And this is what I want to, in the next slides, to show a bit more about that. So what we inherit from the COVID crisis was very strong expansions, fiscal expansion, monetary expansions, all around the world. Supply bottlenecks, problems with the distribution chain and trade. So there was a supply disruption, demand expansion. That's inflation. and we inherit very high rates of inflation from the COVID crisis. Now, again, when one looks at Latin America, one would say rate of inflation that went between 2 and 4% and went up to above 10% in most countries to 14, 15%, you would say, looking at the past, this is if you would take it time series, it will take 10 years, or many countries will stay with high rates. And what we saw was a very rapid reaction of monetary policy in Latin America. The gray line in the right panel is the Fed that started raising rates like 1 year after Latin American economies. Latin American economies start in mid-2021, raising rate very sharply with a lot of concern and controversies that may have from the political point of view, but that's very good because central banks are independent, and what we have seen is that inflation have come down, as we would have expected. The output costs have been quite limited, and the disinflation has been quite successful. Still, we haven't reached long-term, the pi star or pi bar, as you want to call it, to long-term target. Still, the inflation persistence has been a little bit longer. All inflation target framework said a couple of years to return with the inflation to the target. It has taken 2 to 3 years, and still we are not in target. Those are discussions that we may have in the next Chapultepec conference, and many discussions that we economists want to have to meet us from time to time. But from a deep point of view in the countries, the issue is 1 or 2 points of inflation, but has been extremely successful. Two things that I would like to talk, and I think that are quite important and were also important during the last crisis, and the first is risk sharing and exchange rate in emerging market. This is something that we grew up saying, if exchange rate depreciate a lot, the government will go bankruptcy because they borrow in dollars, they cannot borrow in their own currency, there is original sin. At the BIS, some work intensive that we has been also done on this issue, but all of this came looking at the Chilean experience. And I think that's quite fascinating because it's extreme. Chile had a revolution in October 19, we can say was social unrest. It was close to a revolution that now we can say was social unrest because the revolutionaries didn't take power and there was no guillotine, but we were very close. Okay, we had a huge social uprising in the last quarter of 1919, and what we saw during that period, okay, from late 1919 to late 2021, was that the net international investment position, the blue line, went from minus 15% to 5% of GDP. So during that period, we received a transfer from the rest of the world of 10 percentage points of GDP. On top of that, I'm sorry, 15% was was from 40 to 15 was 15%. The net international investment position declined. Okay, was 22 minus 5. But the current account deficit was 6%. So you have to add that to compute the price effect due to the exchange rate depreciation and the decline in the stock market. Basically, we are short in our equity and we are short in pesos, and the rest of the world takes part of the adjustment. And it was a sharp transfer from the rest of the world to Chile in extremely difficult moments, but that's what we call insurance. So the issue was how this worked for the rest of emerging markets and how this happened. So basically, I will show you here a summary from a paper that I have, which is basically this is the net financial weight. Basically, this is a number that when it is above zero, a depreciation of the dollar reduces your net international increases your net international investment positions, you gain. When it is negative, you are short in dollars, so you lose with the depreciation. This is basically, so it takes what the fraction of your asset and liabilities are in dollars and compute that weight. What we see is that since the late 1990s until roughly 2006, 2008, this was improving. And this also coincides with the period of financial opening. So in a way, financial opening was also a way not to go to get more vulnerable, but to get insurance and hedging. So this is, it had changed my way to see many of it. Then it stabilized, okay? But what's happening today, an exchange rate depreciation for countries improve. This is like we used to call this for the US and for advanced economies, but also happen is that we don't have negative wealth shocks with the depreciation. So the depreciation helps on the trade balance, but also helps on the net international investment position, so we would be enjoying some sort of exorbitant privilege. These things that has been long discussed for the case of the US, and I think that has been quite an important development. There is heterogeneity across countries, but we see, and this is consistent with the story that we have had sharp depreciations and no emerging market, well, except Turkey, Argentina, well, there are always countries, but normal emerging countries had suffered significantly from this. And finally, this is, I think that is very, things that I have been, this is still in a work in progress, but these macroprudential policies and capital controls, the purpose of both of them from the financial point of view, they may have many objectives, but is to tighten to tighten financial conditions, to reduce credit, and well, that's the idea of the macroprudential, and is to control credit booms and all of that. So basically using, this is what's going on in the world. We see that capital controls are relatively stable for the last 20 years, so there hasn't been a very big change in this sample of countries, but there has been much more the use of macroprudential tools. So what I will show, basically, we want to know whether capital controls, that was our H0 hypothesis. We said, well, capital controls and macroprudential tools should increase credit constraint for economies and for firms, and because that's what this measure wants. Mm-hmm. And the way to see it is just to see this is a very old, well-known thing from Fasari and Harvard. You take the investment and you control for cash, and cash is an indicator of how important are a credit constraint for investment. So then you interact this with the policies, and you say, well, this is positive. And what we see is basically the first line, capital controls increase the importance of cash affecting investment, so it tightened financial conditions. What we surprisingly found is the other way around for macroprudential policies. They don't tighten financial conditions. And this is a long discussion. We separate between macroprudential, the F is macroprudential tools that affect the financial system, capital requirement, and those sort of things, that they don't have effects. But what we found is that those that affect borrowers, mainly loan-to-value ratios, those affect positively the rest of financial constraints. So we think that there is, and we discuss more that, we think that there is a substitution effect. So banks and financial institutions start reducing lending to households, but maybe increasing to corporations. So those are things that we're thinking now, but I think that's quite important, basically, because we're thinking how to have tools to affect financial stability, because to promote financial stability, because we know that that's one of the big Achilles heel of the business cycle in emerging market economies. So with that, thanks.
Thank you very much, Jose. Maybe one point that I will try to address, it was not only credit provision, it was guarantees by the government, which were guarantees by the government for the loans were extremely important. Otherwise, the banks would have not lent in spite of providing liquidity.
No, it was fiscal and,
The banks knew they had to lend, but they were afraid of lending, of course. No? And there has been a difference between the countries, how they provide these guarantees and credits. In the case of Chile, you gave a 4-year credit being paid after the 4 years. And you adopted a fixed rate of 2.5, if I am not wrong. In our case, we have also 4 years, but they have to start repaying after the first year. And also, the rate was through a bidding process. The banks took a portfolio, let us say, 500 million for these clients. We will ask for these clients 1.2%, let us say, a year. For their client, 1.5. And at the end, the rate was lower than those fixed by the government, like in the case of Chile. But my sisters, this is very hard. Where I'm afraid, and I have seen something, at least in Peru, the government and Congress believe that it can be permanent. Of course, we have not taken part in any other program. Even the refinancing of these programs were with the money of the banks. We provide liquidity to the general system, but we didn't provide for any specific loans anymore. But the government has created a lot of new programs, also giving guarantees. Have you seen that in Chile, also a pressure for more of these type of loans?
That's very interesting because we did start with the application of this credit guarantee were different across countries. In Chile, even there was some facilities of the central bank to private banks, but they were contingent of that they were lent to corporations. So there were many variety. Now, you're completely right. This is a typical problem in public policy and in fiscal policy. You provide a guarantee for COVID, and then you say, well, but let's keep going. Because also they say because it has worked. In the case of Chile, it was a law with a limit, so it ended, and there was no more pressure to go with that. Despite even, I think that there is also a tension with the hiking, with the tightening of monetary policy that should create more incentives for firms to ask for guarantees. Now, in the case of Chile, there is also a very old tradition of a very small and credit guarantee. So you can say we can get rid of those because you still have those that are for small and enterprises.
And that problem that you addressed partially was, I remember Hausmann, 2001, I believe, no? He talked about original sin. Original sin was the inability of emerging market countries to issue debt in their own currency because there was no credit in fiscal policy, risk of default, no credit on monetary policy, risk of inflation. But at the same time that this name was getting popular, we were issuing more and more debt in domestic currency. But now the problem I see in many countries in Latin America is the risk of fiscal dominance is becoming more and more important. I still see a lot of credibility in monetary policy, but I see less, not enough, but less credibility in fiscal policy than 5-6 years ago, no?
Yeah, that's also quite important because it is true. Now there is the governments, they borrow, they don't need to issue in New York, but they issue in domestic currency, and there are a lot of foreign investors that wants to lend. Now the problem, I think that this is interesting. I don't have made completely my mind now. But after the COVID crisis, we ended with a very high public debt all around the world. Interest rates are still low, but I would say it's one of the main macro risks that economies face today is that public debt in the last 15 years have been rising non-stop, and it had a lot of fragility. However, and this is the part that I would like to, however, there is also this idea that there has been fiscal dominance, that to a large extent, the last inflationary spike was caused by fiscal dominance. And this is Barrow and some quotes that they have been. And part of the inflationary period that we had the last couple of years have reduced the real value of debt. I would like to look more at the numbers, but I think that that's something that wouldn't make so high the levels today, but I haven't seen carefully at the number. I think that the BIS can do it.
Well, thank you very much. We open the floor for questions. Please, Alexandre.
Thank you very much, Beppo. It's great to try to learn the lessons from this recent economic shock. One thing I think you mentioned here, the countries in Latin America have responded, have started raising rates in early 2021, while during that period we have very important advanced economies that were still debating whether the shock was transitory or not. And I mean, emerging markets don't have the luxury to wait and see, as we know. But what's your view on, do you think perhaps the central banks went too far in responding to the COVID, in cutting rates in the first place? What's your view with the benefit of hindsight now?
Yeah, that's it. I always have to, one is the discussion that we can have in a group of economists and say, well, many times I say, well, perhaps the Central Bank of Chile should have been not that tight or could have waited, and then we go to Brazil and say, well, they're hiking. Overall, it has been impeccable, I think. There is an issue about timing, but this issue about timing has a lot to do with how you view monetary policy, where you have to raise rates in a consistent way and not to wait a month and then in another 2 months, because it creates a little bit of volatility. So there are issues that perhaps on a month-to-month basis we can discuss. Perhaps sometimes monetary policy may go a little bit far, and let's say, well, it may cost output 0.5 percentage point of GDP, things like that. Yeah, could be, and this is country by country. But overall, I think that has been extremely good. Most countries start raising rates very much in advance, which needs a bit of courage because it's very easy to raise rates after the Fed has raised rates. But you start a year before, and then inflation starts coming down, and there are no big concerns in countries about the control of inflation. We have in Latin America, in particular in Chile, inflation has been politically very costly. Otherwise, ask Biden. But this is because if prices go up, but they don't go down, they stay up, and you control inflation. Now, we have also the advantage in Latin America that we can blame Biden too, and the expansion of fiscal policy around the world that caused us to have more inflation. In the case of Chile, we have another excuse that also is very useful to say people, you know, when you do silly things, is that we had 3 withdrawals of pension funds in Chile that were extremely damaging, and people receive a lot of money, and we say, well, that was cause inflation, and so people now is, so we learn. And so I think that there has been, still we need to reach a target. Okay, that's fine, but overall has been extremely good, I think.
Several question, please.
Yes, thank you. About your last point on macroprudential and capital control, or CFM. I actually happen to have a very similar research going on, and I fully sympathize with you about your point on leakage. You tighten housing credit, then it can shift to corporate or some other forms. And I guess that sort of, in a sense, challenges this traditional view that if you tighten macroprudential and CFM at the same time, they should have a better outcome than only do one or the other. Because leakages can happen in different ways. For example, you tighten macroprudential and then capital banking inflow may actually increase because banks may want to borrow not from domestic but from foreign sources. And CFM may help, but may not help enough because now there's a spillover effect. So in this kind of circumstances, what do you think is the best way to combine the two? Still, there are a lot of sort of complex leakages.
So you say with monetary policy, with the
monetary policy given fixed. I mean, if monetary policy also added, that's another dimension. But assuming the monetary policy is going the same direction.
You want to combine
macroprudential and CFM. How do you
and
capital control?
Ah,
yeah. Because eventually, these two can be used at the same time. Yeah.
But I would say more in general. You want to be contractionary all the way with all the tools. It's kind of contradictory to say, well, I will take care with macroprudential, I will take care of the financial fragilities, but also reducing interest rate in monetary policy. So I think that there has been consistency. Regarding capital controls, I have become, with my own research, very skeptical about capital controls. I think that they shouldn't be used. I think that first, financially opening is good, and this is, and second, it gives you this is policy and experience, because at the beginning when Chile started applying capital controls, I was in the government, the finance ministry, so I had to be a good soldier, and I say that they were excellent too. But then when you think more about that, capital controls, and this happened also in Brazil, gives you the impression that you are isolated, that you can hike interest rate as much as you want because you control capital inflows. And that doesn't happen. And that's what causes an appreciation, a lot of inflows, and I think that they are not that effective. I believe a lot in having a strong financial system. Microprudential tools, whatever, we have to be very careful. But thinking about capital controls, a way to avoid capital inflows, I think that they are not very effective, and it creates this idea that you are isolated and that you get rid of the trilemma, and no, that doesn't happen.
Well, we have time for a last question. Yes.
Thank you for the presentation. You have shown us clearly now that central banks in the region have been able to run counter-cyclical policies. My question is if you think some of the countries are ready now to run policies not that are counter-cyclical, but that go counter. My question is if countries are ready to, or some countries in the region can run policies that go counter the Fed. No, you have shown us that now countries can experience very large depreciations and there is no significant pass-through, no significant episodes of financial instability, but still many central banks are afraid of going to differentiate strongly from the Fed, even if local conditions warrant that, because there can be an episode where foreign investors run away from government bonds. But my question is, countries that have low current account deficits and that have deep capital markets, no? Like Chile, like Mexico now, are they ready now to distance from the Fed and knowing that maybe you're going to have capital outflow, but you have a deep enough capital market that can counter that exit and that governments can finance their deficits with local markets, or the region is still trapped and binded by what the Fed does?
I have problems with the sound that is...
maybe I can say partially, because actually Chile and Peru has rates below the Fed before the global financial crisis for almost a couple of years. I think in that Thailand has a rate of, and the 10-year bonds are 2.9, something like that, no? So you can do it. Probably we might need somewhat more credibility, but we can do it. Actually, when I'm thinking about reducing the rate, I'm not thinking so much of the Fed, as the market believes, no? Probably we cannot go much down. Probably we're not Thailand yet, but probably we can be below the Fed without much damage, let us say, no? But
I have two concerns about that. First, we have deep financial markets. There is a capital flows, arbitrage, and with all the things, and Mexico and Brazil much bigger capital markets than many other countries. There is one thing that I think communications in central banks is quite important. So I think that when a central bank starts saying, well, that there may be a concern because our rates could be lower than the one of the Fed, I think that that's a mistake, first. Second, there is no reason why there is kind of a threshold. So if we get to the Fed, then there is a collapse. And it's kind of where you put the zero, it doesn't matter. Life is a continuous. So I think, and this has created a lot of, I would say, again, it's a short-term turmoil in our markets because it's well, will they cross or no? So I think that communication is very important. And this was one that somebody told me when I was at the central bank, you are cutting rate too fast and the dollar could go up, but who cares? I said, that was kind of my answer. Was a little bit blunt, but it's a, so I think that, and the second is the deep reason. We are interconnected. There is arbitrage. When interest rate moves, exchange rate moves, but that's the adjustment. And let's not exaggerate the adjustment, because if you change 1 year rates but 1 point, well, you may have to add a lot of noise to have a depreciation of more than 1%. So it's so markets move a lot in the short run. Sometimes central banks have to intervene, but I think that having very interconnected markets hasn't changed at all the capacity of central banks to do policy and to do whatever they want, I think.
Well, no, we have no more time, so thank you, Jose, very much.
We will now have a coffee break. Please, we will reconvene at 4 p.m. to the next and final session. Thank you very much. session with a panel discussion on future challenges for monetary policy in the Americas. As we look ahead, understanding these challenges will help us prepare and steer our monetary policy effectively. Our moderator for this session is our colleague, Frank Smets, who is the Deputy Head of the Monetary and Economic Department and Head of Economic Analysis and Statistics of the BIS. He was previously as the ECB, where he was advisor to the Executive Board and Director General of Economics. Please join me in welcoming Frank and our panelists to the stage.
So, last but not least, the final panel, and I'm very much honored. It's a great pleasure to chair this panel of very distinguished speakers from central banks in the Americas. They bring a vast body of experience in central banking and are, of course, uniquely qualified to talk about the topic of the last session, which is future challenges of monetary policy in the Americas. And of course, we've heard already about some of these challenges by Augustine at lunch. We've also heard before in the previous session that central banks in the Americas have built credibility and tackled the challenges during the pandemic. But of course, there are further challenges ahead. One of them is that, particularly in some countries, bringing inflation back to target still has to be fully achieved. The other issue that has been mentioned many times is that navigating the monetary fiscal policy mix is a challenge in a world of higher public debt and potentially higher risk premium for government debt. And of course, more generally, central banks will need to continue to guard and keep the financial system healthy. Also preparing for external shocks, like changes in global interest rates and trade tensions, continues to be a significant concern, as we've heard several times. And all of this is happening in an environment of more severe and frequent climate-related shocks and rapid technological change, as Governor Escriba also mentioned. So we're very much looking forward with this panel to further explore some of those challenges. Before I give the floor to the first governor, let me briefly introduce the panelists. I would like to start with the governor of the central bank of our host country, Victoria Rodriguez Ceja. She was appointed governor of the Bank of Mexico in January 2022, and before being appointed governor, she served as Undersecretary of Expenditures and of the Ministry of Finance and Public Credit from December 2018 to December 2021. Joining us virtually, and okay, there he is, we are grateful to have Tiff Macklem from the Bank of Canada. Tiff Macklem was appointed governor of the Bank of Canada in June 2020 for a 7-year term. He joined the Bank of Canada in 1984 and held various senior positions. And I still remember my first pass at the BIS was in the 90s, and we kind of interacted at that time, particularly on modeling, I remember. Tiff was appointed a deputy governor in 2004 and a senior deputy governor in 2010. And from 2014 until his appointment as governor, Mr. Macklem was dean of the Rotman School of Management at the University of Toronto. Our third distinguished panel is President Laurie Logan. Laurie Logan began serving as the 14th president and CEO of the Federal Reserve Bank of Dallas in August 2022. And previously, she had the important role of manager of the System Open Market Account for the FOMC at the Federal Reserve Bank of New York, where, of course, she played a very important role in the development and the implementation of the Federal Reserve's response to the COVID-19 pandemic, but also to the global financial crisis. And then finally, our fourth panelist is Governor of the Banco de la República Colombia, Leonardo Villar. Leonardo Villar became governor of the Colombian Central Bank in January 2021. Previously, he was executive director at the International Monetary Fund for Spain, Mexico, Colombia, Venezuela, and 4 Central American countries. He was also a member of the board of directors of the Colombian Central Bank for 12 years and held various senior positions at the Colombian Ministry of Finance. So a wealth of not only central banking, but in general economic policy making experience. As Governor Maklam can only join us for a limited time, let me first give the floor to the Governor. Floor is yours.
Well, thank you. Thank you, Frank. I'm really missing being with you and my many central bank colleagues from the Americas. The thing about shocks is they disrupt more than the economy, but I am very pleased to at least be able to talk to you virtually about the challenges that lie ahead for central banks. There is lots to talk about. But my first order of business, I want to congratulate and thank Augustine Carstens for his leadership as general manager for the Bank for International Settlements. Your term, Augustine, has been marked by significant global upheaval, from pandemic shutdowns to war in Europe and double-digit inflation. These have not been easy years. Through it all, you've been a source of unwavering wisdom. Your clear thinking in the face of the unknown, your long view, and your deep understanding of our global interdependence, all combined with the experience and pragmatism of a former Minister of Finance and then central bank governor, have made you an invaluable leader. More than that, through the BIS, Augustine, you've brought us together with your friendship and your ability to get to the heart of the matter. You've helped us learn from each other, and you've made us better together. I know there will be an opportunity to celebrate you in Basel as your retirement in June approaches, but I really wanted to recognize your exceptional leadership in your home country. For those of us in the Americas, your special interest in our region has been deeply appreciated. Whatever you do next, I know Mexico and the Americas will be an important part. Thank you, my friend. Now let me turn. Now let me turn to the challenges ahead. We are facing a global economic landscape that has shifted in recent years, and this shift has important implications for central banks. As Augustine has highlighted in a series of insightful speeches, the structural tailwinds of peace, globalization, and demographics are turning into headwinds, and the world looks increasingly shock-prone. Higher long-term interest rates, elevated sovereign debt, slower economic growth, and lagging productivity all make our economies more vulnerable. Compounding these vulnerabilities are war, rising trade protectionism, and economic fragmentation. In addition, new technologies, including artificial intelligence, are set to disrupt existing industries and create new ones. And we're seeing more frequent catastrophic weather events as the impacts of climate change become more pervasive. As 2025 begins, we are facing new uncertainty with a shift in policy direction in the United States. President Donald Trump's threats of new tariffs are already affecting business and household confidence, particularly in Canada and Mexico. The longer this uncertainty persists, the more it will weigh on economic activity in our countries. If significant broad-based tariffs are indeed imposed, they will test the resilience of our economies in the short run and reduce long-run prosperity. Tariffs mean economies work less efficiently. There will be less investment and lower productivity. That means our countries will produce less and earn less. Monetary policy can't change that. What monetary policy can do is help with the short-run adjustment. But even here, monetary policy has to strike a balance. Significant broad-based tariffs will sharply reduce demand for our exports. At the same time, a weaker exchange rate, retaliatory tariffs, and supply chain disruptions will raise import prices, putting upward pressure on inflation. With a single instrument, our policy interest rate, central banks can't lean against weaker output and higher inflation at the same time. So we will need to carefully assess the downward pressure on inflation from weaker economic activity and weigh that against the upward pressures from higher input prices and supply chain disruptions. Other structural headwinds pose similar challenges for monetary policy. They'll impact both demand and supply, slowing growth while adding cost. Monetary policy cannot address these headwinds directly or offset their economic consequences. In a world with more structural change and more negative supply shocks, central banks will be faced with harder choices. And harder choices bring risks of public disappointment and frustration. We will face criticism about our decisions and about how well monetary policy is seen to have worked when confronted with forces that are mostly out of our hands. We'll be called ineffective or criticized for not doing enough, and some will challenge our independence. So what can all of us do? First, we can be humble about what we don't know, but also confident in the effectiveness of our frameworks. We didn't get everything right through the pandemic, and elevated inflation and higher interest rates have been difficult for our citizens. But in Canada, as in many other countries, inflation has come down, and we restored low inflation without causing a recession or major job losses. Guided by our frameworks, we can maintain confidence in price stability. Second, we need to be just as clear about what monetary policy cannot do. There will always be forces beyond our influence, and while we will need to understand those forces, we should be clear that understanding is not the same as controlling. And we need to avoid the temptation to overload monetary policy by expecting more of it than it can deliver. Third, we can recognize that the world has changed. Structural headwinds and supply shocks require different types of information and analysis. This means investing in richer information about the supply side of the economy and building models that can analyze sectoral shocks and their transmission. It means reaching out and listening to households and businesses. It means looking at our economies through different lenses, regularly challenging our assumptions, and using scenarios to help manage uncertainty. Fourth, let's acknowledge that working together has never been easy, and it is getting harder. But let's also remember it's important. We are more effective if we confront our shared challenges together. The shared resolve of central banks to fight the post-pandemic surge in inflation helped us all bring inflation down. This was a positive international spillover, and together we can generate other positive international spillovers. Finally, we need to remain evidence-based, technocratic and professional, and free of political influence. We need to be open, accountable, and transparent. And we need to be learning institutions. When faced with valid criticism, we should critically evaluate our policy actions and be willing to improve. Being independent and accountable and continuously learning is how we build trust. The world is a tougher place today than it was just a few short years ago. And facing the headwinds will not be easy, but that's why we have independent central banks. We're designed for tough times. I look forward to hearing from my esteemed colleagues on this panel. Thank you very much.
Thank you very much, Governor Macklem, for reminding us what central banks can and cannot do. And with that, I turn to Governor Rodriguez for her introductory remarks.
Thank you. No sé si funciona el micrófono bien. Good afternoon. Muy buenas tardes a todas y todos. First of all, I would like to thank the BIS and its representative office for the Americas for the invitation to participate in this panel and to congratulate Agustín for this enriching initiative. Muchas gracias, Agustín, por reunirnos el día de hoy. Let me start by saying that Banco de México's monetary policy conduct has focused at all times on the accomplishment of our priority mandate of price stability. When global shocks derived from the pandemic and the war in Ukraine led to a clear and pronounced upward inflationary trend, a clearly restrictive monetary policy stance was attained as required by the severity of the episode. The hiking cycle was concluded when the disinflation process started and made progress due to the fading of the effects of global shocks and the actions of the monetary policy implemented. Later, as disinflation advanced, the inflationary outlook called to start reducing the monetary tightening, and we decided to initiate this process gradually. Throughout last year, although headline inflation was affected by non-core component volatility, it located at 4.21% in December. This reading was the lowest for a year-end since 2020. Later, it declined to 3.69% in the first fortnight of January 2025. On the other hand, core inflation kept declining during 2024. Its evolution confirmed the noticeable improvement to resolve the inflationary episode originated by global shocks. Core inflation has located around its pre-pandemic historical average for the 2003 to 2019 period, according to the most recent data. The permanent inflation target was defined at the start of that period. In the first fortnight of January 2025, core inflation stood at 3.72%. Regarding its components, merchandise inflation has reached particularly low levels, clearly below those previous to the pandemic. Moreover, services inflation, although it remains at relatively high levels, it has already shown gradual reductions. This suggests that this inflation would be, to a greater extent, generalizing further. Going forward, headline inflation is expected to converge to the 3% target in the third quarter of 2026, and core inflation to reach that level in the second quarter of that year. These forecasts are subject to risks. The persistence of core inflation 3% target. We consider that this is consistent with a lower level of the reference rate relative to that demanded due to global shocks, although the monetary stance still should remain restrictive. The board estimates that looking forward, it could continue calibrating the monetary policy stance and consider adjusting it in similar magnitudes. It anticipates that the inflationary environment will allow to continue the rate-cutting cycle, albeit maintaining a restrictive stance. We contemplate that in the next meeting, we may consider a downward adjustment of similar magnitude. We are anticipating that the inflationary environment will allow for further cuts during the rest of the year, although maintaining a restrictive stance. Without losing sight of the fading of global shocks, the progress in disinflation, and the levels already reached by headline and core inflation, we will remain vigilant to current challenges in upcoming meetings. In that regard, we are facing the uncertainty related to the potential effects of policies that the new American administration may adopt. Given our high economic integration with the US, if policies affecting trade and financial flows between the two countries materialize, it would have consequences for the macroeconomic conditions of our country. The effect on Mexico's economic activity would be negative, while those on inflation would have counteracting outcomes. Although greater economic weakness would tend to moderate price pressures, a greater exchange rate depreciation could generate upward pressures on inflation. In this sense, inflationary pressures could be observed both to the downside and to the upside. The challenges that the Mexican economy will face in 2025 highlight the importance of having solid macroeconomic fundamentals, as they allow facing such events from a position of resilience. Mexico stands out among emerging economies for the strength of its macroeconomic framework. In this regard, several macroeconomic pillars of the country stand out. First, external accounts are sustainable. An adequate level of international reserves that may be complemented with resources from the flexible credit line contracted with the IMF. The banking system maintains a solid position in terms of liquidity and capitalization. A significant fiscal consolidation was approved for 2025 with the aim of maintaining the soundness of public finances. And the country has a flexible exchange rate regime which operates as a shock absorber. The latter has allowed us to focus fully and with a long-term perspective on achieving and preserving an environment of low and stable inflation. Thank you.
Thank you very much, Governor Rodriguez. And then we turn to President Lori Logan, please.
Thank you. Thank you, Frank, for the earlier introduction and also for moderating today's discussion. And I want to thank the BIS for inviting me to participate in this distinguished panel and for hosting this event at such an important time. International dialogues like today generate so many valuable insights about how central banks can navigate the current environment, and I'm really pleased to be able to be here this afternoon. And I too want to thank Augustine for his leadership and his friendship over so many years. The theme of today's panel is future challenges for monetary policy in the Americas, and I have to say when I thought about today's panel, it was tough to think about where to begin. I think one challenge, of course, is to note all the important challenges when we've been each asked to keep our remarks to less than 5 minutes. But today I would like to highlight 3 topics in particular. The reconfiguration of global trade patterns and supply chains, the shift to a higher interest rate environment, and the need to keep inflation expectations well anchored after the surge in inflation following the pandemic. But before I discuss these 3 topics, let me note that the views are mine and not necessarily those of my colleagues on the FOMC. In recent years, companies worldwide began to reorganize their supply chains in response to disruptions experienced during the pandemic, as well as geopolitical developments. Government policy changes in this space are ongoing, and the resulting changes in trade patterns could leave a substantial imprint on economic activity. For example, a Dallas Fed economist and a colleague at the Banco de Mexico found in their joint research that tariffs on China drove growth at Mexican firms integrated into global supply networks. Central bankers will need to parse what these shifts mean for the inflation and employment outlooks and for capital flows. At the Dallas Fed, we recently launched our Global Institute to study these and other questions, and we look forward to generating new insights that can advance the missions of the Federal Reserve and our other central bank colleagues. Turning to my second point, following the global financial crisis, many experts thought a core challenge of modern central banking was downside risk to inflation resulting from the proximity of interest rates to the effective lower bound. While a return to the lower bound remains one scenario to prepare for, the past few years show we must be equally well prepared to achieve our goals when rates are well above zero and inflation risks are to the upside. Related, this brings me to my third point. Central banks will need to ensure inflation expectations remain well anchored following the recent global inflation surge. High inflation has been costly for households and businesses. It would be surprising if this episode didn't cause people to reevaluate how they expect inflation to behave going forward. In the US, while market and survey-based estimates of long-term inflation expectations have remained largely stable, survey measures of inflation uncertainty rose sharply at the start of the pandemic, and they remain elevated. I take this as a reminder that expectations won't stay anchored forever on their own. In the end, monetary policymakers have to achieve what the public expects. And as we all know, well-anchored inflation expectations are critical to success in monetary policy. History teaches that when inflation expectations become unanchored, central banks often can restore price stability, only at a great economic cost. This lesson figures centrally in my thinking about monetary policy for the US in the near term. I think the possible policy strategies for the FOMC in 2025 boil down to two key alternatives. In some scenarios, it will soon be appropriate to resume reducing the Fed funds target range. In other scenarios, we'll need to hold rates, at least at the current level, for quite some time. Inflation made progress toward the FOMC's 2% target in 2024, while the labor market remains strong and stable. If these trends continue, the US economy will have achieved a soft landing. Yet we've been here before on inflation. It cooled substantially in late 2023, then resurged in early 2024. And January 2023 was unusually strong as well. My team's analysis and conversations with business contacts suggest these bumps may result from an interaction between annual pricing decisions and the business cycle. Many businesses set prices once a year in January, and they have more pricing power when the economy is strong, as it has been in recent years. We don't yet know whether 2025 has brought another such bump, but if inflation rises, it will be a signal that monetary policy has more work to do, both to restore price stability and to keep demand in balance with supply so we can sustain price stability. Now, what if inflation comes in close to 2% in coming months? Well, that would be good news. It wouldn't necessarily allow the FOMC to cut rates soon, in my view. Suppose, for example, that as the first quarter unfolds, monthly inflation figures come in at a 2% annualized rate. Labor market indicators hold right where they were all fall. And consumer spending and business investment also stay strong. I'd find it hard to say monetary policy was meaningfully restrictive in that scenario. One aspect of the global higher rate environment is that the neutral interest rate appears to have moved up, though it's uncertain exactly how much. On-target inflation, alongside 2 quarters of stability in the labor market and demand, would strongly suggest that we're already pretty close to the neutral rate, without much near-term room for further cuts. On the other hand, if the labor market or demand cools further, that could be evidence it's time to ease. There are many uncertainties right now beyond the near-term inflation and employment data. I mentioned trade policy, and as we'll probably come back to later in the panel, financial conditions have also been volatile. But to me, the monetary policy implications of these uncertainties generally come down to whether sustainably restoring price stability requires keeping rates at least at the current level or moving lower. And in choosing a path, we should be guided by the need to maintain well-anchored inflation expectations, which are fundamental in the long run to achieving both sides of the FOMC's dual mandate for monetary policy. So thank you for continuing the conversation.
Thank you very much, President Logan, for going through some of those scenarios and what it may mean for monetary policy going forward. And let me then turn to Governor Villar.
Well, thank you, Frank. It's very difficult to speak the last after these interventions of my colleagues, which I entirely share. So it's very difficult to say anything new. And even more when we had a launch in which Agustin Carstens mentioned the challenges that we may have in the future with monetary policy, which I subscribe entirely. And I took note of those challenges. It's my presentation, essentially, which is uncertainty, to deal with uncertainty about tariffs, about geopolitics, to deal with the high public debt in most of our countries and at the world level, to deal with the international divergences in policies, and to deal with the sluggish productivity growth, which may push us to ease monetary policy when we should not do that. But as Agustin said, we should deal with all these challenges, taking in mind that the instruments we have as central banks are instruments that allow us to concentrate on inflation and in keeping inflation down, and keeping inflation under control. So I entirely share those views, and it's very difficult to say anything else, but I will try to say anything. In the case of Colombia, there are still significant challenges to bring and consolidate inflation around the target. In a context of very uncertain fiscal policy, global trade fragmentation, and growing concerns about global financial conditions. Inflation has experienced a significant drop in the last 2 years. Headline inflation has fallen by more than 8 percentage points since its peak in April 2023, when it reached 13.3% to 5.2% last December. Still, inflation in Colombia has proven to be more persistent compared to other countries in the region and remain above the central bank's 3% target. This persistence is mainly explained by a strong indexation to past inflation, which has to do with the lack of credibility in a country in which inflation was too high for many years in the past, to exchange rate pressures, especially during the last quarter, and to significant increases in the minimum wage. With regards to the minimum wage, they have been, the minimum wages have been increased every year well above the observed past inflation during the last 4 years. For 2025, again, the government announced an increase of 11%, which represents almost 6 percentage points above the last year's headline inflation and 8 percentage points above the inflation target. So it can produce additional inflationary pressures, mainly in the services sector, which has inflation stubbornly high, as happens in many other countries of the world, in our case, around 7%. Inflationary pressures have also risen since the last quarter of 2024 as a result of exchange rate volatility associated with global developments and with domestic larger than expected fiscal imbalances. Government revenues fell more than expenditures in 2024, and the central government deficit, which was projected to close around 5.6% of GDP, may end up at 6.8% of GDP, well above the limits imposed by the fiscal rule. In addition to this, the 2025 budget was rejected by Congress due to overly optimistic revenue projections, and therefore both the budget and fiscal results remain surrounded by a high level of uncertainty for this year. The same is happening with the government sectoral policies, particularly those related to health, energy, education, and infrastructure, in which the current government has shown a significant anti-private sector bias. Global geopolitical fragmentation and uncertainty around trade policies of the new US administration may also create difficulties in the process of adjustment of inflation in Colombia. The US is Colombia's largest trading partner, and that implies that potential trade restrictions, along with economic and financial sanctions, such as those with which the US government threatened Colombia last week in the context of the debate about deportations, will have significant impacts on our economy. Furthermore, the US immigration policies could create major challenges for Colombia through the effects on remittances and their impact on the disposable income and consumption of Colombian households. Around 50% of remittances come from the US, so the impact of stricter immigration policies or any changes in the tax policy related to remittances will have also significant impact on Colombia. In this very uncertain context, inflation expectations have also gone up during the last few months, standing today at around 4% for end 2025, which is the upper limit of the tolerance range of plus or minus 1 percentage point around the 3% target. Hence, our main challenge as central bank continues to be bringing inflation around the target and consolidating credibility in our inflation targeting framework. That's why Banco de la República keeps a very contractionary monetary policy, and the process of reduction in the interest rate that we had been pursuing for 9 consecutive board meetings since December 2023 was paused in our January meeting last week. Even if we have the future full control of inflation, a question that I think we have to think about is whether we should think on a goal of around the price level. What we have seen in the States, but it's a discussion that is all around the world, is that the population understands that inflation has gone down, but keeps insisting that the prices are not what they used to be. And I think that's something that is a challenge of communication, perhaps, but maybe also a challenge for policy that, of course, is not a short-run challenge that we can address today with keeping the goal of counter-cyclical policies on economic activity. Having mentioned the huge challenges with regards to the traditional macroeconomic role of monetary policy, I would like to mention shortly other important challenges we face as a central bank in relation to more operational tasks that have been discussed earlier today. In particular, the development of an interoperable fast payment system, the possibility of issuing a CBDC, the improvement of our cross-border payment instruments, and the regulation of crypto assets. In Colombia, our primary effort currently focuses on the implementation of a fast payment ecosystem developed by the central bank, which will be launched in the third quarter of 2025. It will be a fully interoperable system that is expected to bring more competition to the market, building on the foundations of well-established private fast payment systems that we already have in Colombia, which, however, work as closed gardens for few groups of large institutions. We expect that the launching of the new platform that we call Breve will lead to a significant progress in digital payments. In that context, there is an ongoing debate regarding the necessity of launching or not a retail CBDC. Our official stance on this debate is that a retail CBDC could bring an additional set of significant operational and reputational risks to the central bank, while its potential benefits, such as programmability or offline payments, could be enabled by using fast payment systems with commercial bank money. On the other side, we find more positive arguments regarding the potential benefits of using the crypto technology to tokenize commercial bank deposits at the central bank, thus creating a wholesale CBDC. These types of arrangements, the wholesale CBDC, may simplify settlements among commercial banks to facilitate cross-border transactions, including remittances, and make them faster and cheaper. Wholesale CBDC may be useful to obtain interoperability among wholesale payment systems in different currencies, and could also be useful in processes like the integration of the stock exchanges of Colombia, Peru, and Chile that is currently underway. This type of CBDC is consistent with the Agora project mentioned by Hyun this morning. The tokenization of central bank deposits in a wholesale CBDC is a good example of potential use of crypto technologies to improve the payment system in our countries. I must confess, however, that I find extremely risky the way in which crypto assets issued by the private sector are growing very rapidly without the required regulation, especially when those crypto assets are designed to work as means of payments or to serve as stable coins that mimic the performance of national currencies issued by central banks. The regulation of such cryptocurrencies is clearly one of the most difficult challenges that central banks and supervisory and regulatory agencies may have during the next few years, both in advanced economies and in emerging market economies. The regulatory framework should allow mitigating risks, but without affecting incentives for technological innovation. In this regard, in Banco de la República, we have agreed that the new regulation should pursue the following objectives in line with what Hyun and Professor Christine Parlor said in their presentations today. First, to guarantee that the development of digital assets does not risk financial and macroeconomic stability or reduces the capacity of central banks to control monetary and exchange rate policies. Second, establish the rules that help protect consumers and investors of digital assets. Third, prevent the use of these assets in illicit activities. And fourth, establish a regulatory framework based on the principle that the same activity implies the same risks and therefore the same regulation. Meeting these objectives will be key to gaining transparency and clear functioning of digital assets while allowing to take advantage of their innovation and new activities that can have a positive impact on economic growth. I stop here. Thank you.
Thank you very much, Governor Villar, and also for widening again the scope of all the challenges that central banks are facing, particularly in the technology field and in the field of payments. Maybe we can continue the conversation by addressing and deepening some of the questions that were already discussed. Governor Macklem sort of emphasized the challenges that will come from the fact that we're likely to continue to live in a world where supply shocks will continue to be important. And of course, there is this sort of common wisdom that to some extent, when these supply shocks are temporary, that one can look through them. But of course, what we've seen in the past is that, and you've mentioned it in your introductory remarks, that some prices, and particularly services inflation, has been relatively sort of sticky. Yeah. And so one question is, how do you interpret that stickiness? Is that something that we will have to take into account also for future shocks? And of course, related to that also, what are the risks of some of the trade tensions that is one example of these type of supply shocks?
Yes,
Governor
Rodriguez.
Rodriguez.
For your question. Well, I will start talking about the first question you asked. What risk do trade tensions pose for inflation in the coming years or in the future? And you mentioned what I said about services inflation in Mexico, that as in all or other countries have been sticky. And I would like to start by saying that although this inflation process has its own peculiarities, it is different from the other, but I think we can say that we have observed that they go through some similar phases. First, at the beginning, when the fading of the shocks that originated the episode that originated the inflationary episodes diminished, the inflation leads or has a faster decline. And later, we observe that inflation, when it gets closer to the target, the pace at which inflation comes down usually diminishes. So I would like to start by saying sharing these initial ideas, and going into the case of Mexico, I would like to share that during this episode, with the mitigation of the shocks and, of course, the implementation of the monetary policy stance, the strong response that Banco de Mexico started to get the inflation to the target, we started to see the disinflation phase process started, I would say, in early 2023, and headline and core inflation diminished quite fast from particularly high levels. You might recall that the headline inflation had a peak in August 2022 at 8.7%, and it diminished to 4.66% in December 2023. Core inflation had a similar behavior from 8.51% in November 2022 to 5.09% at the end of 2023. So we observed that at the beginning of the fading of the shocks, as I've mentioned, we saw a decline of the inflation in a relatively quiet pace. Then during 2024, core inflation continued decreasing primarily due to the behavior of merchandise inflation, as I've mentioned. However, headline inflation was affected by the volatility of the non-core component. And in 2024 and in 2023, services inflation showed persistence. This contrasts with the clear downward trajectory of merchandise inflation. Both components undoubtedly were affected by cost pressures. However, as we all know, good inflation faced a more dynamic demand since the beginning of the pandemic. As we all know, there was a reallocation of consumption from services to merchandise because of the confinement. And I think that allowed companies to pass through higher costs to consumer prices more quickly. But we did not see the same behavior on services. Services sector faced a weak demand for the same reasons I've mentioned, which made the pass-through more difficult. And as demand recovered, accumulated costs were passed through consumer prices. However, the process has been slower than anticipated. And going to your next question about the risks of trade tensions, I think it's useful to go back and review how the period of increased trade cooperation was a powerful disinflationary force. First, as we all know, consumers gained access to a greater variety of cheaper goods, and a greater competition from foreign producers disciplined the price formation process. Also, firms gained access to higher quality inputs at competitive prices. We saw also technology adoption and innovation, and a robust productivity growth that led to higher economic and wage growth without inflationary pressures. Of course, Mexico benefited from this process. NAFTA in particular represented not only lower tariffs, I think, but the creation of an institutional framework that increased North America's competitiveness through sophisticated regional production chains. However, I would like to highlight that we have been experiencing for over a decade a reaction, I would say, against globalization, with the risk of oversimplifying. I think we can identify insufficient redistribution of the gains from trade to those affected by it. Of course, there are other factors that contribute to a less globally integrated economy, such as national security concerns, among others. And I would say that in the case that tariffs become more persistent and generalized, or that production relocates in response to factors different than cost efficiency, the world could face decreased competition, lower investment levels, and less incentives for technological adoption and innovation. And I think that could translate into lower global productivity. And I think central banks, of course, have to remain vigilant to the evolution of the trade tensions. Our job, as always, is to adopt actions to ensure orderly price adjustments and to anchor long-term inflation expectations. And I would like to close by saying that as policymakers, we need to reflect on how we got here, how we are where we are today. And I think that it is important and would allow us to address the task of ensuring a more equitable growth and to strengthen the international cooperation efforts needed to face our shared challenges. Thank you.
Thank you very much, Governor Rodriguez. Many of these structural forces that we talk about, and of course fragmentation or deglobalization is one of them, but also digitalization, climate change, population aging, they're not only a source of sort of supply shocks or shocks in general, but they also affect some of the so-called star variables that are important in sort of setting monetary policy. So, President Logan, I mean, how important do you see concepts such as the neutral interest rate for monetary policy making? I mean, which factors do you think affect the natural interest rate? And I don't know if you also have a perspective on sort of the international dimension, where, of course, international capital markets come in. What are sort of some of the drivers? Are they the same across the world, or do you see also differences?
Well, thank you for the question. And I did bring up the neutral rate in my opening comments. But when I think about monetary policy, I often don't start from the neutral rate. I think because I come from a background in financial markets, and I think the nuances of financial markets matter so much. I start thinking more about financial conditions more broadly. Households and businesses don't usually borrow, save, or invest at an overnight risk-free rate like the Fed funds rate. Instead, as we all know well, most borrowing, saving, investing takes place at longer tenors and often incorporates various risk premia as well. So when I think about whether monetary policy is in the right place to accomplish our dual mandate goals, I tend to think about whether broader financial conditions are appropriately restrictive or accommodative, or whether broad financial conditions need to move from where they are today. Yet, we don't control financial conditions. We control the overnight policy rate. And that overnight rate's relationship to broader financial markets can vary over time. So I don't usually try to judge whether the policy rate itself is restrictive or accommodative, but instead I think through how moving the policy rate will affect those broader financial conditions. All that said, I think it's helpful to have some benchmark for the policy rate over time. And here I think estimates of the neutral rate, or R-star, are one important benchmark. But as I know we've all talked about, I would highlight the word estimates in that comment. The neutral rate can't be directly measured, has to be estimated by consulting models and observing the evolution of the economy over time. And the estimates depend on so many assumptions. It's also necessary to think about the time horizon, and the neutral rate in the long run can differ from its value today. As a result, when we see estimates of R-star in the US right now, they vary pretty widely. I was looking across a suite of available models, and the estimates of the neutral real interest rate for the US range from 0.75% to 2.5%. So a pretty wide range of those estimates. And if you look in the December summary of economic projections, FOMC participants' estimates of the long-run real Fed funds rate ranged from 0.4 to 1.9%. But one thing these estimates generally have in common is that most of them have moved up substantially since before the pandemic. And for example, in the December 2019 SEP, estimates of the long-run real Fed funds rate ranged from 0 to 1.3%. So you can see the shift that's happened over the last several years. You asked sort of how I think about the drivers of those. Conceptually, the neutral rate depends on the balance between the supply of investment and the demand for investment. Factors that move investment supply or demand also move the neutral rate. And I've been categorizing those into four main buckets. Business investment needs, which can result from drivers as varied as productivity growth, new technologies that we've talked about, or change in trade patterns that we focused on today. Demographics, because longer life expectancies and lower population growth raise those desired savings. And risk premia, because higher structural demand for safe assets means investment supply and demand are in balance at a lower risk-free rate, all else equal. And of course, there's global fiscal policy, which reflects the desired savings and investments of governments. Demographics, one of those four, change slowly and have weighed on neutral rates for many years, but the other factors can move quickly. And post-pandemic, many of them point in the direction of higher investment, lower savings, and thus higher neutral rates, just as the models and the estimates I talked about have shifted. Because global capital markets are relatively open, I tend to think these factors operate globally and affect neutral rates across economies. Indeed, when we look at the model estimates of R-star, they've tended to move in parallel across developed markets for the past half century. But country-specific developments also matter. So I think it's important to think about what we're seeing in each of our jurisdictions. But all this just brings me back to where I started with the importance of broad financial conditions. While some of the drivers of the neutral rate are purely economic, others, such as risk premium and capital flows, relate to those nuances that we see in financial markets. And adjusting neutral rate estimates to account for these financial factors is an inexact science. And so while measures of R-star are a helpful benchmark and an important one to look at, it'll always be important to take broad financial conditions into account in thinking about setting the monetary policy rate.
Thank you very much. So one of the things we haven't actually talked a lot about at this inaugural Chapultepec conference is climate change. And so let me ask a question to Governor Villar about how do you see the impact of physical risks, and unfortunately we've seen quite a number of those events over the past months, but also the transition risks for monetary policy.
Okay, thank you for the question. It is very difficult to assess the way and the magnitude in which physical climate shocks and the energy transition may affect monetary policy. My short answer will be that they create additional volatility in inflation and in GDP figures that may require more active policy management in order to stabilize those variables. In addition, for a country like Colombia, which has been a net oil and coal exporter, energy transition may imply a long-term decline in export revenues, lower potential GDP growth, higher current account deficits, and higher neutral real interest rates. The magnitude of these permanent impacts is, however, extremely difficult to estimate. Our staff at the central bank has made research on this and suggests that the research that suggests that the impact of global warming by 2100 could reduce GDP by nearly 8% without mitigation policies. This highlights the importance of proactive climate policies, including efforts to mitigate the effects of climate change. However, most of those climate policies are a responsibility of the government and not of the central bank, which do not have the instruments for that. Still, the Banco de la República is already incorporating climate-related variables, such as El Niño shocks, into its forecasting models. This provides a better understanding of how extreme weather events can influence inflation expectations and prices. Given the potential for persistent and frequent climate shocks, central banks may need to adopt more flexible and responsive monetary policies to anchor inflation expectations and avoid second-round effects. From the exercises that have been done with those models, it seems clear that, in general, monetary policy cannot use a look-through approach when it faces an increase in inflation as a consequence of climate shocks. The main reason is that many prices and also wages in Colombia show a strong indexation to observed inflation, which implies that any increase in inflation may create long-term upside pressures on inflation, even if the initial shock was strictly temporary. It is very difficult to avoid second-round effects from an inflationary shock in a country like Colombia with the strong inflation indexation mechanisms. It is very likely that the optimal response to an increase in inflation, even if it is caused by a temporary shock, will be through a monetary policy tightening. I would say that.
Thank you very much. I think we're getting close to the end, but maybe I can ask one final question. Governor Macklem talked also a lot about communication. I mean, given these many challenges that we're facing in the very uncertain environment, how do you think about sort of central bank communication in this environment? I mean, some of you emphasized the importance of having anchored inflation expectations. What are sort of the tools that we have in order to make sure, indeed, that in this volatile world, inflation expectations remain anchored and price stability is maintained? I mean, I don't know who wants to take that question. Governor Villar?
I would say something that is just to emphasize the importance of having a specific goal for monetary policy. I think if we start having many goals, it will be very difficult to communicate. If we relate monetary policy with inflation, we can communicate to the public that we are the responsible institution for bringing inflation down. I have seen the debates in my own country in which the government says, no, we brought inflation down, so now you have to bring down interest rates. So I think it's very important to communicate which is the causality from interest rates and monetary policy to inflation, and keeping it simple is very, very important for the purpose of anchoring inflation expectations and getting some support for our role.
I think the clarity of our goals and being and staying focused on that, I completely agree with that comment. I think that's been a real benefit of many of the frameworks that have been put in place and communicated publicly, that clarity of goal. I mean, I like the opening comments also about humility, particularly in the uncertain world and environment that we're in. And I think expressing that humility is really important. Because of that, I think it's also important that when we're communicating about our economic outlooks, we often talk about our modal outcomes and our modal forecasts. But in this world of uncertainty, I think it's really important to talk about the scenarios and the reaction function. And so in my remarks today, I really tried to think about how the data that we may see may influence the way I think about policy. I think that's really important in a world with so much uncertainty.
Thank you. Governor Rodriguez, you want to have the final word?
Thank you. Well, I would, of course, agree with my colleagues. Communication is of the utmost importance, and I think during this difficult episode that we have faced globally together, communication has been really important, and I think clear and consistent communication along with a firm commitment and the communication of that commitment, of course, to price stability is essential in anchoring inflation expectations. And I think what we have seen, speaking about what we have seen in Mexico, is that the inflation expectations, long-term inflation expectations, have been well anchored. And we at the board at Banco de Mexico are really committed and continue to look to improve our communication tools. Banco de Mexico has gone through different tools along the way through many years, and many of the people that are here come from Banco de Mexico, if they are today, or most of you come from Banco de Mexico, even if you are in another places. And I'm glad to meet all of you here. And I would like to close by saying that the communication is totally really important. We have, as you know, started a new communication during the pandemic episode, as we thought it required. And I think that was very helpful to, first of all, communicate the commitment of the board, as Banco de Mexico has always been. And, well, finally, we are seeing that this inflationary process is going forward, and we will continue to remain committed, of course, to the price stability mandate. Thank you.
Well, thank you very much. It was great to hear your views about the future challenges for monetary policy in the Americas. I think I can only thank you very much for participating in this conference, and let us give a round of applause to Over to Anna.
Thank you all for your participation and engagement during the conference. This is our first edition of the Chapultepec conference, and I think the discussion has been interesting, successful, and I think we all are very happy that you are here. So now I would like to invite Alessandro Tombini to deliver the closing remarks.
Thank you so much, Anna. I think this has been a great journey. As I see this agenda, I start missing Chapultepec conference already. I think the good news is that we're going to have other editions of this very nice conference. So as we come to the close to this first edition of the Chapultepec conference, we should be filled with a sense of accomplishment. And I thank you all for that. In particular, I thank all the governors that came here in large numbers, very substantial leadership here in the central banking and financial community. So that's very, very important for us, and is a testimony of how important such an event like this can be. Over today's session, we have delved into crucial topics for the central banking community, for the financial system, which included a number of items, like global financial conditions, we start with that, the conduct of monetary policy, the role of cryptocurrencies, tokenization in the financial system. We also delved into the integration of digital payments in the Americas and challenges and opportunities of the digital age for the society in general, but also for central banks. We discuss the challenges for monetary policy in our continent, especially during these testing times. We have heard the word uncertainty very frequently in our discussions today, and so I think gives an idea of the kind of environment that central banks and societies in general are facing these days. These discussions have been both insightful and thought-provoking, highlighting the current complexities of our environment. This first edition of the Chapultepec Conference has set a very high standards, and I'm confident that it will become a reference in the years to come. As we live today, I hope that each of you is taking away not just answers, but also new questions that will drive further inquiry, research, and innovation in our respective institutions, be them central banks, academia, or even private sector institutions. After all, the hallmark of a great conference is leaving with as many questions as answers, and I think that has been the case again today. Finally, I would like to extend my heartfelt thanks to Banco de Mexico in the person of Governor Victoria for the excellent support that Banco de Mexico provided to this conference, and also the BIS team. We have a large contingent and very substantial from Basel, here present in Mexico today. I won't talk about Agustin yet, but the Monetary Economics Department, Communication, Banking, all here to support this event. And my thanks to my colleagues from Basel, but a special thanks to the Americas office, which worked very diligently and has been very instrumental to making this conference a success. Thank you all for your participation. We look forward to seeing you in future editions of the Chapultepec Conference. And I will end here, but I will ask you to stay in your seats for a little longer so that we can take some final photos of the event. Thank you very much for your participation.